Welcome to Acera's pre-retirement webinar. I am really excited to help you all prep for retirement. In this webinar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even the 3 months or 3 weeks leading up to retirement, depending on how far out it is for you. Maybe it's pretty close. The bottom line is that you're probably watching this because you're going to retire soon. And because you're going to retire soon and you're curious enough to participate, you probably have some questions. Questions like, what do I need to know? What do I need to do? Well, I'm going to answer all of those questions for you during this webinar. And I think I know about 95% of the questions you're already going to ask. And I've arranged the answers to your questions into the form of this checklist that we're going to go through during this webinar. Okay, so first off, I'm going to help you understand your Acera membership. And we'll talk a little bit about your contributions to Acera. I'll show you a retirement timeline, and we'll talk about your tier with Acera. Then I will help you get a an estimate for your retirement benefit that you're going to receive in retirement. We'll talk a little bit about the retirement formula. We'll talk a little bit about considering purchasing service credit. I will talk at length about how vacation affects the salary component of the retirement formula, because people are always curious about that. And then I will show you how to use our benefit estimator tool in our member portal when you log into your account on our website. In the second half of the presentation, I'm going to help you verify your retirement eligibility. I'm going to help you choose your retirement date and tell you everything you might want to know about choosing that exact date. We'll talk about the process that it takes to actually retire because there is a little bit of a process. There's an application that you got to fill out. And I'll talk about the 5 retirement allowance options that you're going to choose one of on your retirement application. And it's good to know how those work and what those are. I will also tell you about some other benefits that we offer to retirees, including medical, dental, and vision benefits. And I will talk a little bit about some other life events that may happen and what that means regarding your Acera membership. And that will take us about 3 hours and 15 minutes. So let's jump right in. First off, let me help you understand your Acera membership. Who is Acera? I'll start at the beginning of the story, okay? Now, Acera, in one sense, is this acronym that stands for the Alameda County Employees Retirement Association. Okay, now it's made up of a lot of people, though. There are, I think, 92 or 93 of us that work at Acera currently. We're all county employees. So, like many of you, we're county employees. And what we do, our entire job, is to provide retirement, disability, and death benefits to our members. That's you. So you are also part of a who of the who that is Acera because you are a member of Acera. And as an Acera member, that your membership started because you work currently or at some point in the past you worked full time in a retirement eligible position for one of the 6 public agencies in California that use Acera to provide retirement benefits to their members, to their employees. So if you work for one of these agencies and you work in that retirement eligible position and it had to at least start out full time, you could go down to part time later, but it had to start out full time, you automatically became an Acera member. And in fact, your membership was mandatory, so automatic and mandatory. And as an Acera member, once you started your Acera membership, you began paying into Acera's fund with every single paycheck that you received. And you're continuing to pay into Acera's fund with every paycheck. So if you look at your paycheck and you go to the before tax deductions column, and you'll see a line there that says retirement or something similar. Maybe it says your tier. We'll talk about your tiers in a minute. And you'll see money being deducted from your check, and that comes out of your check and goes into Acera's fund each and every paycheck. And every time that happens, your employer is also contributing to Acera's fund on your behalf. So that we have an employee contribution, an employer contribution, and we don't want that money to just sit around and collect dust. So we invest it in a diverse portfolio of investments all over the world with the goal of earning interest, which we, over long periods of time, earn a significant amount of interest. And it's these 3 sources of income, the employee employer contributions, and the investment earnings that give us this big pool of money that we call a Sarah's fund. Okay, so why are we collecting all this money and investing all this money? What are we going to do with it? Well, you, in your retirement eligible position, throughout your career, in your Acera membership, are earning more and more and more credit toward retirement the longer you work. And you earn credit in three different categories, which I'll talk about when I talk about the retirement formula. But the longer you work, the more you work, the more and more credit you earn. And the reason you're doing that is because at some point in the future, you're going to retire and you're going to stop earning credit toward retirement and you're going to start to collect on the retirement that you earned during your career in the form of a monthly retirement allowance for the rest of your life. You cannot outlive your retirement. It happens each and every month on the last business day of the month for the rest of your life. It's a guaranteed source of income that you can plan on while you're still working. You can get very specific projections, which I will show you how to do a little bit later. You can plan on it and you can count on it in retirement because it's guaranteed for the rest of your life. Now, you'll note that I'm using the term monthly retirement allowance here. This is a synonym for a lot of different terms that we will throw around during the presentation, including pension, pension benefit, retirement benefit, pension allowance. These are all kind of mix and match terms that we use, but it's all the same concept. You're going to get paid a retirement allowance that you earned every month for the rest of your life. It's kind of a beautiful thing that you get to participate in a defined benefit pension plan like Acera. Now, let me show you some milestones that you will encounter. And you probably, since you're nearing retirement, you've probably encountered many of these already in terms of during your membership with Acera. So, your first milestone is your date of hire into that full-time retirement eligible position. This is your first day of work in that position. Now, what happens for 4 of our 6 employers is that 2 weeks goes by, and the first day of your second pay period is your date of entry into Acera. So this is the day that you start earning credit toward retirement. Now, there's 2 employers, Livermore Area Recreation and Park District and the Housing Authority. There is no 2-week lag. Your first day in that retirement eligible position is your date of entry into Acera. Okay, so now you're an Acera member. You start earning credit toward retirement and you start paying into the system. Okay, so let's say that you work full time for 5 years, or you work something less and you work the equivalent of 5 full-time years. Once you earn what we call 5 years of service credit, which is one of the categories that you're earning credit in toward retirement. So basically, you work 5 years, you earn 5 years of service credit with Acera. You are considered vested in the retirement system. And vesting, it's kind of a loose concept. It kind of loosely means guaranteed. So when you become vested in this retirement system, you start being able to unlock the guaranteed benefits, the vested benefits that the system provides. Okay, so now you're vested. There's some indeterminate amount of time after that. And it's through some combination of your years of service and your age that gets you to retirement eligibility. And I'll show you what those combinations are a little bit later. This is the first day that you could physically retire from Acera if you choose. So this is the day that you could go into retirement if you want. Now, many people do not retire on that day on their first retirement eligibility. Many people keep working past that to earn more and more credit toward retirement because the more credit you earn, the higher your retirement allowance is going to be. And I'll show you that in a few minutes. So that's why I've kind of put a gap here in the milestones. Okay, the next milestone is your last day on payroll with your employer, also known as your termination date. This is the date you leave employment, and this is the day that you stop earning credit toward retirement with Acera. And then for many people go straight from active work into retirement. So the very next calendar day would be your first day of retirement. And this is the day that you start collecting your lifetime retirement allowance. Now, that does not apply to everyone. Some people will leave their work and they will defer their retirement to a later date. And then there would be a gap between these 2 milestones. And that's totally fine. You can definitely do that. And I'll mention that at the end of the presentation if you are thinking about doing that. Okay, so now you are you have reached your retirement date. This is a date that you choose. You tell us when you're going to retire, and you do that by uh, telling us on your retirement application and submitting it. And then you're retired and you start drawing that lifetime pension payment every month for the rest of your life until your death. That is when your retirement payments stop. But you'll see there's one more milestone on the chart. And that's because at the time of retirement, you have the opportunity on your retirement application to choose a beneficiary, and in some cases, multiple beneficiaries for a what we call a continuance payment, which in most cases would be a continuing monthly payment for the rest of the beneficiary's life. And so, upon your beneficiary's death, if they die after you, we would continue paying them a certain continuance payment. I'll talk about what those payments might be when I talk about the five retirement allowance options. Um, and upon your beneficiary's death, that would conclude Acera paying out all the benefits that we owe you and your beneficiaries. Okay, let me talk briefly about this worksheet here. This is a piece of a worksheet, and in fact, I'll show you how to get to it. There was a link in the email we sent out. If you didn't access it yet, totally fine. All you need to do is go to your browser and type in acera.org/worksheet, or you can navigate to it by going to acera.org. Then you go under news and events. You go down to retirement planning seminars, the fourth thing down. And then you go right here under webinar options. You go to pre-retirement webinar, open that accordion up, and you'll see there's a couple of PDFs here. One is this presentation handout, so you can have a copy of the PowerPoint that I'm showing you today. The other one is a retirement planning worksheet. And this is a tool that we developed. It kind of goes hand in hand with this webinar because we found that through the course of the 3 hours and 15 minutes, I throw out a lot of info at you, and you learn a lot of numbers about your particular retirement situation and your retirement membership. And so this is a handy place to record those numbers if you want. So this is purely optional. You don't have to do this. You could just record the numbers on a scratch piece of paper. You could print out the, retirement handout and write down the numbers there. This is a fillable worksheet, so if you do want to fill it out electronically, I suggest that once you open it, the first thing you should do is download it to your device, and that way when you fill it out, you can save it. You can save your changes, and then you can keep it on your device. So I'll be referring to this a few times throughout the presentation, but like I said, it's purely optional. It's only if you want to use it to keep track of your numbers. Okay, so going back to the PowerPoint presentation, you'll note that this is the first section, my career timeline. This is the first section on the worksheet. And if you want to, at this point, you could go ahead and record your Acera entry date if you happen to remember it. If you don't happen to remember exactly what it is, you'll note I put approximate dates in here. That's totally fine too. If you know that you started like November of 1999, you could put that in here. And also at this point, if you want to, you could pencil in a projected retirement date if you already have one in mind. But I say pencil it in because I may tell you something during the choosing your retirement date section that may make you want to adjust your retirement date by a few days. Okay, so I just wanted to say a couple more things about vesting real quick. I said vesting kind of means guaranteed. The guarantee comes from state law. State law tells us how to administer Acera's fund, how to administrate it, how to basically do everything. And the guarantee comes from state law. So we always abide by the law, as does your employer. So you have nothing to worry about. And the guaranteed benefits, the vested benefits, are that monthly retirement benefit for life, that monthly retirement allowance. Also, an annual cost of living adjustment, which is a percentage increase you'll receive annually to your retirement allowance on April 1st each year. I'll talk more in detail about that later. And then a $1,000 lump sum death benefit. Now, there are additional death benefits available to your beneficiaries, including that continuance I already mentioned. And we'll talk about that later when we talk about the 5 retirement allowance options. But I just wanted to mention this $1,000 lump sum death benefit because that's this kind of extra lump sum death benefit that your beneficiaries would be eligible for. Okay, so if you want to write in your vested date. You basically take your Acera entry date and add 5 years. It's not super important to know what that is. Um, and you, and if you've already, you already know you've worked here for 5+ years, you don't even have to worry about it. Okay. So let me tell you about your tier. Your tier is based on the date that you entered Acera, so your first day of Acera membership. So let me help you figure out which timeline to look at here. If you are a safety member, you're going to look at the bottom timeline, and safety members are sheriff's deputies and probation officers. So, safety members, you're looking down here. If you're not a safety member, you're what's known as a general member. So, you're going to look at this top timeline, unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Park District, and then you're looking at the timeline for your employer. The way this works is that if you enter a SARA before the cutoff date for the end of the tier, that puts you in the earlier tier. So anyone who's a general member who entered a SARA before July 1st, 1983 would have gone into tier 1. If you entered a SARA July 1st, 1983 all the way up to December 31st, 2012, that would have put you in tier 2. If you entered a SARA January 1st, 2013 and beyond, that put you in tier 4, and that is the case with all 4 of the timelines. You'll note the Housing Authority has a different tier 1 cutoff. LARPD, there's no tier 2. They have a tier 3 that they negotiated for their employers, and there's a different tier 1 cutoff. Safety members, you have 3 different tier 2s. And if you entered a SARA between October 17th, 2010 and December 31st, 2012, you had the choice of these 2 tiers, tier 2C, tier 2C or tier 2D, and you had 45 days within the inception of your safety membership to choose, and if you didn't, you were defaulted into one of them. Okay, now before I move on, I'll just say that if you don't remember your date of entry, you don't know which tier you're in, there's a very easy way to figure it out. All you got to do is log into your account on our website. So let me show you that real fast. Okay, you navigate to acera.org. Okay, and you can do this from any page on acera.org. You'll note up here there's a login button. That's how you log into your personal account with Acera. And this tool, this portal that we offer is called Member Direct. Okay, so if you've logged in here, since we relaunched this in for the active members, we relaunched this in November of 2024. And we sent out a pin letter to everyone because you need a pin to do your initial enrollment here. If you didn't take advantage of that, you're going to need to request a pin. Now, if you've already logged in and you created your account since that time, you're good. All you need to do is log in with your username and password. If you haven't done that yet since that time, what you're going to need to do is go down here, click the enroll button, go over here to enrollment pin. This is where you're going to put your enrollment pin, but you're going to need to request an enrollment pin. So you click the link, request an enrollment pin. And then you put in your social security number, last name, birth date, zip code, request pin. Okay. Now what that's going to do is it's going to generate a letter on Acera's side. We'll get it in the mail immediately, but you are going to have to wait a few days to receive it. And then once you get that letter in the mail, it will have instructions on where to go. And it's going to take you back to this page, the enrollment page, where you can put in that pin. And then you fill out the rest of the info. You create a username and password, create some security questions, and click enroll, and it will get you right in. Okay. Now, if you have any trouble enrolling, we have some videos on that. If you go under members and you go down to videos, there is a video down here. It is called Acera account login help. And you watch that video and it will walk you through, it will help you troubleshoot any different trouble that you have with that. Okay. Once you log in there, you'll be able to see your tier and your date of entry and a ton of other data that we have on file for you in our database because you will be able to access your personal account. Okay, if you want to, on your worksheet, you can go ahead and mark which tier you are, um, and we'll move on to the next section. So in this section, this will culminate in me helping you estimate your future retirement benefit. Okay, but before we get there, I want to give you some details about how we're going to calculate your benefit, because this will help you understand how we're going to do that final calculation, what the estimate means. It will also perhaps help you do a little bit of final fine tuning to dial in the monthly retirement allowance to make sure it's the maximum that you um, can possibly get that you have earned. Okay. So I'll give you some details about that. So I do want to walk you through this pension formula. Okay. Now it's actually pretty basic. If you are allergic to math, don't worry. It's just a simple multiplication, and I'll explain everything here. Okay. So when you go to retire, a Sarah will use this formula, and in fact, our pension software does this for us. But it will use this formula to determine the dollar amount that we're going to pay you every month for the rest of your life. Okay. And you'll see that there's three things being multiplied here, these three factors. These are the three areas that you are earning credit toward retirement in. Okay. You have an age factor percentage, you have your years of service credit. So this is how long you work, and you have your highest average monthly salary. Okay. So here's how this works. Let me walk you through this. Okay. When you go to retire, you will get, as your monthly retirement allowance for life, you will get a percentage of your highest salary for each year of service that you worked during your career. Now, this sentence is saying in English what this multiplication is doing. Okay, let me plug in some numbers here, and I think it will help illustrate this a little bit easier. Okay, let's say, for example, that the percentage of your highest salary that you are going to get for each year of service is 2%. So we'll plug that into the age factor percentage area here. Okay. So you're going to get 2% of your highest salary for each year of service. Now, let's say, for example, when you retire, you earned exactly 20 years of service credit. So we'll plug that in here, 20 years. So that means that you basically worked for 20 years in that full-time retirement eligible position, or the equivalent of 20 years. Maybe you worked 18 years full-time, and then the last 4 years you worked half-time. Well, that would add up to 20 years. Okay. Now, what this means is that the percentage of your highest salary that you're going to get for each one of those 20 years of service is 2%. So you're going to get 2% of your highest salary for each individual one of those 20 years that you worked. Essentially, we are adding up 2% of your salary plus 2% plus 2% plus 2%, 20 times. We're essentially multiplying these together. 2% times 20 is 40%. Okay. Now, we know your monthly retirement allowance is going to be 40% of your highest average monthly salary. So to finish out the example, let's say your salary was $5,000, that your working salary was prior to retirement. Your retirement allowance, now we know if to finish out the multiplication, is going to be 40% of $5,000, which if you multiply it out is $2,000. Okay, so that becomes your retirement allowance for life. Now, because this is a multiplication, the higher any of these three numbers are, the higher the monthly retirement allowance is. So the higher the age factor percentage, and the age factor percentage increases the older you are. I'll show you a chart about that in just a minute. The higher the service credit, the longer you work, the more service credit you have. So that makes that number go up. Or the highest average monthly salary. I'll show you how we calculate that in a few minutes, but that can go up throughout your career through the cost of living increases. Sometimes you get raises. Maybe you'll switch jobs to a position that pays higher, so you get a promotion. You know, things like that will increase your salary. So any increases to these three numbers increase your monthly retirement allowance for life. Okay, so first, what I want to do is talk a little bit more give you a few more details about how we arrive at each one of these three numbers for you in your situation. Okay. So I'll tell you in detail first about the age factor percentage, and then I'll talk about the service credit and highest average monthly salary. So your age factor percentage that we plug into the formula for you is not necessarily going to be 2%. It's going to be based on your tier and your age at retirement. So what I'm showing you here is a sample of the chart that we use to determine that, okay? What you do is you find your tier on here. So if you're a general tier 2 member, for example, you just look at this column, forget about all the other columns. If you're a safety member, let's say you're safety tier 2B, you look at this column, okay? And so on and so forth. So you look at your column, forget about all the other numbers. Now, let's say you're a general tier 2 member and you retire at age 60. Well, if we look at the chart under general tier 2, age 60, the age factor percentage is 1.92%. So this is the number. If you retired at age 60 and you were a general tier 2 member, we would plug that into the formula for you. You would get 1.92% of your highest salary for each year of service. So you'll note that the older you are when you retire, the higher the age factor percentage. And so this is kind of one of the ways that you earn credit toward retirement simply by aging. The older you are, the longer you wait to retire. The older you are, the higher the age factor percentage you'll get, up to a maximum 4-year tier. So you'll note there's a blue box in each one of the columns. That denotes the maximum age factor percentage you can get if you are in that tier. So if you retire at age 65 as a general tier 2 member, you would get 2.43% in the formula for you. If you retired at 66 or 67 or 77, you'd still get the 2.43% maximum. So once you reach the maximum age for your tier, the age factor percentages stop increasing and they hold steady at that maximum age factor percentage. Another thing I want to point out here is that these are just a few of the age factor percentages that, for this sample chart. There are actually incremental increases to the age factor percentages. If you look at the full chart, and you can find that on our website at acera.org/age, with every 3 months that you age. So your age factor percentage goes up 4 times every year. And it's based on your birth date. So, for example, if your birth date is January 15th, 3 months after that, on April 15th, is 1 quarter after your birthday. So if you age past April 15th, you'll go up 1 notch in the age factor percentage chart, and you'll see that there is an incremental increase to the percentage that we would put in the formula for you. So every 3 months that you age, based on your birth date, you go up 1 notch in the age factor percentage chart, of course, up to the maximum for your tier. Okay. So that's a lot of detail about the age factor percentage. The kind of bottom line there, though, is that the older you are when you retire, the higher the age factor percentage is going to be. I will revisit this when we talk about choosing your retirement date, because I do want to help you not miss whatever the next age factor percentage is increase. Okay, so let me tell you about the second factor in the retirement formula, years of service credit. How do we tabulate your years of service credit? Well, you start earning service credit when you enter Acera, and you are going to continue earning service credit the longer you work, all the way up until you leave your job, until your date of termination from your job, your last day on payroll. Service credit is measured in years, so if you log into your Acera account, you'll see that if you've worked 15 plus years, you'll see a lot of decimal places. It'll say like 15.748264. I don't actually know how many decimal places. It might be like 4 or 5 though. And that is actually us calculating your service credit down to the fraction of a day. You earn service credit every 15 minutes that you work. Okay. And you'll get all those decimal places in the retirement formula for you. So the example I gave you showed 20 exactly. That should actually be 20.000000 because Whatever the decimal places are, the fraction of a day up until the last 15 minutes of your last day on payroll, you get all that service credit. When do you earn service credit? During your regular work hours. That makes sense. But you also earn service credit on your earned leave times when you mark those on your timesheet. So when you go out on an earned vacation, when you go out on sick leave, if you have management leave, when you go out on that, if you have comp time, holidays, floating holidays, when you mark those on your timesheet, you earn service credit during that time, though those do not count against you for earning credit toward retirement. Now, there are times when you do not earn service credit. If you're ever out on leave without pay, you're not earning service credit. If you purchase extra vacation, which some of our employers will allow, that is additional to your earned vacation and you mark that on your timesheet, you're not earning service credit during that time. Selling vacation. Selling vacation is a different concept than purchasing extra. Selling vacation is that you have your earned vacation and you don't want to take it, you want to sell some of it back to your employer. A few of our employers allow that. You will get cash for that. You will not get service credit for that. Now, because you get cash for it, that could make the salary component of the formula go up, and I will talk at length about that in a few minutes. You also do not earn service credit during overtime, on-call time, or standby time. Okay, I'm going to talk briefly about purchasing service credit. I find that if somebody wanted to purchase it, they probably would have done it by now. But if you're not aware of this, I just want to introduce you to this concept, and then I'll tell you where to get more information about it. There are some types of time that are eligible for you to purchase, and no, these are some examples, but you'll note there's no such thing as just purchasing extra time, what some people call airtime. You can't just purchase extra time. What the unifying theme here is that there's a type of time that the law did not allow for you to earn service credit during that time, but it does allow for you to go back and purchase that time. Some examples are any part-time work you did for your employer before you were hired into that full-time retirement eligible position and became an ACERA member, that's purchasable. And I'm not talking about contract time or time worked for an outside temporary agency or employment agency. Those are not eligible. This is just plain old part-time. There's some other categories in there like service as needed or what's that other one? I'm blanking on the term seasonal. There's a full list at acera.org/purchase, and you can check all of those out. But it's basically like project work that you did before your full-time retirement eligible position is purchasable. Also, the county's temporary assignment pool time, if you spend any time there, that's purchasable. The 2-week lag time between your date of hire and your date of entry, that's purchasable. Unpaid leave in these three categories, unpaid medical leave for your own medical condition, not a family member's medical condition, is purchasable up to 1 year per instance. Disability leave, when you go out on that, workers' comp also counts here. And military leave. Military leave, it's not prior military service before your employment here. It's you go out on, you're actively employed, you go out on military leave, you return, you can buy that time. And the theme here is that when you return from the leave, you can buy the time. Redeposits of prior memberships. This is where you used to work for one of ACERA's 6 employers. You were an ACERA member in the past. You stopped working there. And when you did that, you took a refund of your ACERA contribution account and basically canceled your ACERA membership. And when you did that, you lost all your service credit that you earned in that prior membership. And then you come back here to work for one of our employers and you think, oh, maybe I shouldn't have done that. Or it was okay for me to do at the time, but I want that service credit back. So you can redeposit an equivalent amount of money and we will give you your service credit back. That is a redeposit of a prior membership. Redeposits of community property. This is where, because California is a community property state, that means that if you earn a retirement while you're married or in a state registered domestic partnership, that retirement benefit that you've earned is one of the pieces of community property that is up for division when you negotiate the settlement of how the property is going to be divided when you get divorced or dissolve your domestic partnership. And often what will happen is part of a member's account will go to the ex-spouse or ex-partner, and they will take a part of your service credit and then a portion of your contribution account that matches that amount of service credit. Now, if they take a refund of their account because they just want the money, we will send you a letter in the mail letting you know that they did that and give you the opportunity to redeposit an equivalent amount of money to get an equivalent amount of service credit back into your account. And that is called a redeposit of community property. Other California public agency work, this is where you used to work for another public agency in California. You're not eligible for their pension system, for a pension in their pension system, usually because you didn't work there for long enough to qualify, or when you left there, you took a refund from their pension system. So you can buy that time as a Acera service credit. There's a full list at acera.org/purchase. If you do want to deep dive on this topic, what I recommend doing, you go out to acera.org, scroll down to here, webinars and seminars, and we have our two main webinars that we do posted right here, easy links. And all you do is it's a YouTube video, so you can just hit play. You can actually click this button to go watch it on YouTube on a bigger screen, but just fast forward to the screen where I talk about service credit. Credit you are earning service credit right here. So you have some time. And then I take a deeper dive into service credit, how to purchase it, what it costs, etc. And so that's what we do in the new employee slash mid-career webinar. Okay, so if you don't like videos and you just want to read all that info is on this page as well. One more thing I do want to talk about regarding the amount of service credit that we will put in the formula for you is regarding your unused sick leave. So if you go straight from active work into retirement, meaning your last day on payroll with your employer is the calendar day before your retirement date, okay, there's no gap here, we will automatically convert your unused sick leave on a 2-to-1 basis to service credit up to a cap. Now, the cap is written in your MOU, your Memorandum of Understanding. If you've never read that, that is available from your Human Resources Department, and so they can provide you with a copy of that. And so what we do is we take any sick leave you have on the books up to the cap that we're allowed to convert, and we divide it by 2 and give you additional service credit. Many of the MOUs, the cap is 125 days. So I'll just give you an example of that. Let's say you have 130 days of service left on the books when you stop working and go straight into retirement. And you're in one of those bargaining units where the MOU specifies only 125 days of sick leave is convertible. So that extra 5 days above the cap, you just lose. Okay, so you don't get anything for that. But then we take the 125 days that we're allowed to convert, we divide it by 2, and that's 62 and a half extra days of service credit. Now, that's not calendar days, that's work days. So if you spread that out over work weeks, that equals about a little over 12 work weeks, which is about a quarter year. So you would get an additional 0.25 years of service credit in the formula for you. That boosts your service credit number in the formula, gives you a little boost to your retirement allowance. What it does not do is push out your retirement date later. Your retirement date is your retirement date. It's just that when we plug in the numbers to the formula to calculate your retirement, it'll be a little bit higher. You'll get a little more service credit. Okay. Next topic. I told you about the age factor percentage in the retirement formula. I told you about how we calculate the service credit. How do we calculate the highest average monthly salary component of the formula? Okay, so let me show you that. When you go to retire, our software has all your payroll records in our database because your employer transmits them to our database so we can do this calculation. Our software will find your period of highest pay anywhere in your career, and that is known in our pension lingo as your final compensation period. Okay. Now, if you're in tiers 1 and 3, your final compensation period is your highest consecutive 26 biweekly or 12 monthly pay periods. In tiers 2 and 4, your final compensation period is your highest consecutive 78 biweekly or 36 monthly pay periods. Okay. Essentially, for tiers 1 and 3, it's your highest year of pay. Essentially, for tiers 2 and 4, it's your highest 3 years of pay. And this is, of course, consecutive pay. Now, our goal is to calculate your highest average monthly salary. So, what we do is we look at the total dollars you made during your highest year of pay or highest 3 years of pay, and our software will take an average. They'll divide it by the number of months in your final compensation period, 12 months or 36 months, to achieve your average pay over that period of highest pay, your highest average monthly salary over that 1 year of highest pay or 3 years of highest pay. And that is the number that we plug into the formula for you. That's the salary component of the formula. Now, the pay that goes into it, it's all gross pay before any deductions are taken out. And there's a few different pay components that could go in here. Okay, your base pay always goes in. That makes up the bulk of it. You could have some additional pay codes, and some of you may have these, some of you don't. If you do have them, sometimes these are known as footnotes, and they're usually based on skill level you have, education level you have. Sometimes you speak other languages in the course of your job. Sometimes you get additional pay for that. Some of the pay codes count toward this calculation and some of them don't, and it's all based on how the law is written. But to make it easy for you, we have it all listed out on our website, acera.org/paycodes. And if you're curious about whether your pay code counts or not, you can go to that site, pull up the PDF for your employer, look for your pay code, and it'll say yes or no whether it counts toward your highest average salary calculation. The one that I do know, there's like 1,000 pay codes. I don't have them all memorized, but the one that I do know is overtime never counts. If you need help finding your pay code on that sheet, your payroll manager usually knows how to find it. Okay, now there are two more. These are the last two bullet points on this page. There's two more types of pay that could be included for calculating your highest average salary. And that is vacation sales and vacation cash out if you are in tiers 1 or 2 and you work for one of the employers that allows this. And so if you work for LARPD, I don't think um, you can do it. Let me check on that real fast. I think it's so um it's Alameda Health System um and Alameda County, the courts, and the Housing Authority. So I believe First Five and LARPD cannot do this. Okay. And you have to be in tiers 1 or 2. Tier 3 is LARPD only, so that you can't do it. And tier 4, the law that created tier 4, the state law disallowed the ability to do this. Okay. So if you're a tier 3 or 4 member, or you work for LARPD or First Five, you could take a little optional break if you want, because we're going to talk about this for 10, 15 minutes. Because it's a little complex, but I'm going to try to walk you through it and simplify it as best I can. Um, because this is a, you know, this is the way that we calculate it, so it makes sense for me to explain it to you. Okay, so what we're talking about in this topic for these last two bullet points, okay? What we're talking about is we're only talking about the time during your final compensation period, your period of highest pay that we're going to use to calculate your salary for the retirement formula. We're also talking about okay, now during this final compensation period, we're talking about these two types of compensation. Now, this is where you have your earned vacation that you earn, okay? Sometimes you don't take your earned vacation. You get cash for it instead. And there's two ways that that happens. One is that you sell it back to your employer while you're still employed. That's known as vacation sale or vacation sell. The other way is that you have vacation left over on the books when you stop working at your job, as of your termination date, and your employer will cash you out for your earned vacation at that point. Now, if your final compensation period, if your period of highest pay is at the end of your career, then that some of that vacation cash out could count. If your final compensation period, and this occasionally happens, you were making a higher rate of pay somewhere toward the earlier in your career, that means that the vacation cash out won't count and only any vacation sales you made during that time would count. Okay. So I'm mostly going to talk about what happens if your final compensation period is the end of your career, because I think that's the case 98% of the time. Okay. So if you are paid, if you sell vacation back to your employer, you get cash. If you're cashed out for your vacation at the time of your termination, you get cash. So the vacation compensation, the total vacation compensation that we're talking about is the combination of these two types of getting paid for your earned vacation. So we're talking about your total vacation compensation that's made during this final compensation period, that highest year or highest 3 years, depending on your tier. Okay. Now, here is how this works. If you receive compensation for your earned vacation that you are not taking, and that compensation happens during that final compensation period. When our software goes to calculate your salary for calculating your retirement, when they look at the total compensation that you made during that final compensation period, it's going to be slightly bigger. When our software takes an average of your highest monthly salary during that final compensation period, because the total that it starts out with in the calculation is larger, that means the average salary is going to be larger. Now you'll remember the average salary, highest average monthly salary, is one of the three multipliers in the retirement formula. So if any of those multipliers go up, including the average salary, your retirement allowance goes up a little bit. So the bottom line here is that if you are compensated for your earned vacation during that final compensation period, it boosts your retirement allowance a little bit. How much is a little bit? What am I talking about? Here's an approximation. So it's not going to be exactly this increase, but it will be roughly equivalent to this. And this is measured in weeks. So let's say that you receive compensation through a combination of your vacation sales and vacation cash out, both or either or, but we're looking at the total between the two. Let's say that the total between the two is 6 weeks of vacation compensation that you receive for your earned vacation that you are not going to take or haven't taken. That would boost your retirement allowance if you're in tier two 3.8% when we calculate your retirement. So from the beginning, from your first day of retirement, your retirement allowance would be 3.8% larger than if you had not been compensated for that 6 weeks of earned vacation. And so you will have that slightly higher retirement allowance every month for the rest of your life. Okay. You'll note the effect gets larger the more vacation compensation you are allowed, that we are allowed to include for the purposes of calculating your retirement allowance. And you'll know that the effect is accelerated for tier one because of the shorter final compensation period, the 1 year final compensation period. Okay. So this kind of shows you why people are interested in this topic. So, like, if you were able to have 8 weeks of compensation included as salary for the purposes of calculating your retirement, vacation compensation, you would immediately get a 5% boost to your retirement allowance at the time of retirement and for the rest of your life. Okay. Now, there's a cap in the law that the law tells us there's a limitation on how much of this vacation compensation a SARA is allowed to include in your salary calculation for calculating your retirement. But you'll note on the slide, I'm saying must. And I like to draw that distinction because um, there are opinions out in the world about this, but my opinion is that this is how the law tells us to calculate your retirement. The law says that there's a certain amount of your vacation compensation that is your salary. and we have to use all of your salary to calculate your retirement. And so we must do it. The law tells us to do it that way. We follow the law. And so if that's how we're calculating it, I should tell you the details of how we calculate it so you know exactly how we do it. So we're just super transparent. We want you to understand how everything works here. Okay, now what you're seeing here is a piece of that retirement worksheet, planning worksheet that goes along with this webinar. It's on page 2. And so what I'm going to do on this slide and the next slide is show you what those limitations are, what the caps are on the maximum amount of extra vacation compensation that Acera is allowed to include as salary for calculating your retirement. So I'm going to show you, I'm going to show what the cap is for Alameda Health System employees first, and then I'll do everyone else second on the next slide, okay? Because it's different between the two of you. Okay, if you work for Alameda Health System, all you need to do to figure out the maximum amount of vacation compensation that Acera is allowed to include for as salary for calculating your retirement is you need to know one number. How many hours of PTO, paid time off, do you earn per pay period? Now, for everyone else, Alameda Health System does it a little bit differently. They lump basically kind of sick leave and vacation in one bucket and they call it PTO, paid time off. So for those AHS employees, I believe it's on your pay stub. It will say exactly how much PTO you earn per pay period. In this example, this person earned 6.7692 hours of PTO per pay period. Okay. Now all you do is need to do a little calculation. If you're in tier 1, you multiply that by 13. If you're in tier 2, you multiply it by 39. And that gives you the limit of your vacation in hours of the maximum amount of vacation compensation that Acera is allowed to include as salary for calculating your retirement. Now, if you wanted to convert that to weeks, you would just divide it by the number of hours in your work week, and then you can go back to this chart and figure out what the potential increase would be for you. Okay. Now, there's one exception. If you are an AHS employee and you're in the UAPD union, you don't have to do any math. You don't even have to look at your pay stub. If you're in tier 1, the maximum hours of is 120, and if you're in tier 2, it's 360 hours. So that would be the maximum hours for you all of how much vacation compensation we can use as salary for calculating your retirement. Okay, so that's AHS. So let me address the county employees and the two other employers that that can do this, which is again, it is the courts, Alameda County Courts and Housing Authority. I should just write that at the top here so I don't have to look it up. Okay, so you all are going to need to know two numbers. You're going to need to know how much vacation you earn per year. This is something that is measured in weeks for all of you. So you earn 2 weeks of vacation per year, 3 weeks, 4 weeks, 5 weeks. I've heard there's some rare people that will earn 6 weeks per year. But you need to know how much vacation you earn per year, and it's based on your seniority. Okay, and you plug that into this area here. This is also on that worksheet. Okay, but you can just do this on paper if you want to. So you just need to know how much. So this person in this example earns 5 weeks of vacation every year that they work. Okay. The second number you need to know is how much vacation you're allowed to sell every year. That is somewhere in your employer's rule book, or maybe it's a loose rule that is not written down anywhere, but your payroll clerk usually knows. If not them, your HR representative usually knows. So your employer will let you sell part of the vacation um, that you earn per year. For a lot of people, it's a maximum of 2 weeks that you're allowed to sell. For some managers, it's 3 weeks. I've heard there's some people out there that have a 4 week max that they're allowed to sell. But you plug that in here. Okay, now if you're in tier 1, all you do is you look at this. You just plug in those numbers here. Okay, so you're just looking at the first column. Now, if you're in tier 2, you need to think about You got to plug that in for each one of these each year in your 3-year final compensation period. Okay. Now that could be that could seem a little complex. The vast majority of people, all the numbers are going to be the same because over that highest 3 years, you're probably earning the same weeks of vacation per year. The payable, amount you're allowed to sell hardly ever changes unless your bargaining unit renegotiates that. Okay, so this is probably gonna be the same all 3 years. But the earned vacation, it could go up during that time. So basically, you just got to think about just like a rough estimate here is you take, if you're in tier two and you're earning, let's say, the highest salary rate at the end of your career, you basically take what you project to be your retirement date and you go back in time 3 years, and that last 3 years will be your final compensation period. And then you divide that up into three 1 year segments and however much vacation you were earning at the end of each one of those 1 year segments, that's what you plug in the formula here. Okay. Now you'll note that you may not even have to worry about that because what's going to happen is that to get the limit, it's going to take the lesser of these two numbers and add them up. Okay. We do have a calculator out on our website that will help you do this if this confuses you. If you go out to your browser and you type in acera.org/vacation, that's a shortcut to get there. And I'll show you that here. So you just go acera.org/vacation, and it will take you right to the spot on this page. And you open up this little accordion here, and there's a calculator in here that you can use. If you're in tier one or tier two, you select that and you put in the amount of vacation that you earn per year and the amount of weeks of vacation that you're allowed to sell, and it will tell you your maximum weeks of vacation compensation that we are allowed to include for as salary for calculating your retirement. If you're in tier two, it'll expand and you'll have to plug in each one of those 1 year segments. So I'll just stick with that example. But all it's doing, it's very simplistic. It's taking the lesser of each of these and it's adding them up. So the lesser of 5 and 2 is 2. 2 plus 2 plus 2 is 6. Okay, so it's not complicated. So if you just want to do that, take the lesser of each one, and the lesser in most cases is going to be the amount you're allowed to sell. You just add that up 3 times, and that's your limit. Okay, now you know your limit. This is the maximum weeks worth of vacation pay, of vacation compensation that you receive either through selling or vacation cash out or a combination. This is the maximum amount of weeks of that money that Acera is allowed to use to consider as salary for calculating your retirement allowance. Okay, now I want to tell you a few more things about this. One is if you want to, how do you maximize this effect? How do you get the most bang for your buck here? How do you maximize the amount of vacation compensation you're receiving to get the maximum, small boost in your retirement allowance? Well, you're going to want to look at how much vacation you're selling and how much you're cashing out, okay? So one way to do it is you just make sure that you have your limit on the books when you stop working. That's by far the easiest way to do it, and you don't even worry about selling any vacation back to your employer. You don't have to fill out any forms. It just all happens automatically. You don't have to tell us anything. We see you get cashed out for it in your payroll records. Um, and everything just happens automatically and you get that boost. Okay. So that's by far the easiest way to do it. Now, I want to give you a different example because some of you might have to sell because you can't get up to the limit from the cash out alone. And that would be in this type of situation. If you're in tier two, if you're in tier one, you don't have to worry about any of this. You just do the cash out and don't worry about selling. If you're in tier two and your numbers give you a little bit of a higher limit, it could be that you could get into a situation where you can't get up to the limit from the cash out alone. So in this example, this person earns 4 weeks of vacation per year. They're allowed to sell 3 weeks of vacation per year. So each year, they earn 4 weeks, and their employer says in their rules that if you want to sell 3 weeks of that four, you can. Now, you don't actually have to sell it, it's just that the rule has to be in place. Okay. Now, if we do the calculator, we go out to the calculator is going to tell them that their limit is 9 weeks because the lesser of each one of these is 3. 3 plus 3 plus 3 is 9. Now, there's this additional rule that your employer has, and this actually applies to everyone. The rule is that they will not cash you out for more than two times your accrual rate. So anyone here listening to this, you do not want to have more than two times your annual accrual rate of vacation on the books when you stop working for your employer. Because anything above two times your accrual rate is just going to disappear. It's going to vanish into thin air and you're not going to get anything for it. Okay. So you look at your accrual rate. In this example, this person earns 4 weeks of vacation per year. 4 times 2 is 8. So 8 weeks is the maximum amount of vacation this person would want to have on the books when they stop working and go into retirement. Now you'll note there's a discrepancy here. If they cash out 8, if they have the maximum that they're allowed to cash out, they can't get up to the 9 limit. Okay, if they had 9 on the books, the extra week would just go poof because their employer will only cash them out for 8 weeks worth. So in this case, you may need to sell if you can't get up to the limit from the cash out alone. So they would want to sell 1 week. So they would just want to plan ahead. I don't think you have to do it that far in advance. You could do it, pretty quickly, pretty soon leading up to your retirement. You just have to do it while you're still employed and sell that 1 week back. And then between the 1 week that you sell and the 8 weeks that you cash out, that gets you up to your limit of 9 in this example. Okay. Now, what happens? You probably have, some of you may have this question. What happens if I already sold a bunch of vacation? I didn't know about this. I didn't know that I should just, focus on the cash out and I sold vacation. Or, you just happen to sell vacation for whatever reason. What happens? Well, that's totally fine. Don't worry. Um, you have kind of two options. So let's say that you're in the same example. Your limit is 9 weeks worth that we can include as salary for calculating your retirement. And you sold 5 weeks of vacation. You're in tier two. You sold 5 weeks of vacation at some point during that um, final compensation period, that highest consecutive 3 years of pay. So we have that on the books. We see that in your payroll records. Okay. So your option number one would be to simply know your limit and cash out the difference. So you look at your payroll records, and it will show you this actually if you do projections, and I'll show you that when we get there. If you do projections in using our benefit estimator in your Sarah account, it will show you all the pay periods. And it will show you whether you have sold vacation during those pay periods in the final compensation period. So if you sold 5 weeks of vacation during that final compensation period, you just cash out the difference. 5 plus 4 is 9. You just have 4 weeks on the books when you retire. That gets you up to the 9 and you're golden. Option number two is if you have more vacation on the books, then whatever the difference is between the two, that's totally okay too, as long as, again, you don't want to have more than two times your accrual rate, annual accrual rate of vacation saved on the books when you stop working for your employer because you'll lose anything above that. So this person had the max that they could cash out and they sold 5 weeks worth of vacation. That's a total of 13 weeks of vacation compensation that they received. All that money went into their bank account, okay? So you're getting, when you sell vacation, all that money goes to you. When you cash out vacation, you get all that money. All the money goes to you into your bank account. It's simply that the numbers come through in your payroll records and we see that and we add those dollars to your salary calculation up to what we can add. So in this example, their limit is 9, so we would add 9 weeks, the 9 highest weeks that we can add to their salary, 9 weeks worth of additional salary to their salary calculation, and that boosts their retirement allowance, you know, a good amount. Um, and they still get all the cash, for getting all that. So, do you have any questions on that um, before I move on to the next thing? Feel free to type those into the Q&A. some people will ask, well, if you have these extra weeks of vacation, you could just tack on vacation at the end of your career and get the service credit for it, but not get and you still get paid for it, right? Like, what's the difference there? Well, the difference there is that then it shifts your final compensation period, and you don't get the effect of having like these extra weeks of salary tacked on. So your service credit does get a little boost, but by far the greatest effect from having the additional vacation is from getting compensated for not using it for this purpose. It's way bigger than if you were to get the extra service credit. Okay, so there's a question that just popped up. If I have reciprocity, and just as an aside for everyone, reciprocity is where you have multiple retirement systems in California linked together to get some synergistic effects between the different retirement systems because you used to work for another place that has a different pension system and you can link them together. And I'll talk a little bit about that at some point in the presentation. So the question is, if I have reciprocity, what would the other agency use as the final compensation? Would they include this vacation sale or cash out? It's a good question. It's likely they would include it or some of it. They may have a different um, interpretation of the law over there. Um, so they may do it a little bit differently over there. The courts, there was a big multi-year suit about this calculation that happened after um, the this practice ended for the Tier 4 people in 2013, and the law also further limited how much we could include. So the calculation used to be different. And there was this multi-year lawsuit, but I think that informed a lot of the pension systems on how to do this. So it's possible they're all doing it similarly. But yeah, if you have questions about how they calculate that and whether they would include that, you would want to check with them. Okay, so seeing no other questions, welcome back Tier 3 and Tier 4 members. Thanks for bearing with us on that. And let me talk about this slide and then we'll take a little break. Okay, so there are some limits on your monthly payments that you receive from Acera. The main one that kind of applies to everyone is that your retirement allowance is capped at 100% of whatever we calculate your highest average monthly salary to be. And this is written into the law to try to prevent you from receiving more in retirement than you were when you were working. And it mostly does that. Absolutely does that. But as we just learned, your highest average monthly salary could be slightly higher based on the vacation compensation. So it is capped at that slightly higher amount. Um, this is kind of, we talk about this as a limit, but really, if you achieve, you got to work a long time to do this. If you're in tier two, it's like 35, 40 years, depending on your age. To hit this cap, if you hit this cap, if you're getting 100% retirement allowance of what you were making while you were working, that's amazing because you are also going to get to collect Social Security in most cases, and then you may have additional retirement savings. So you're set. So that's great. The second two, I'm not going to spend much time on because it's for people who have really high salaries, and there's not a lot of people out there. But just know that these limits exist. We do have more info on them at acera.org/limits, and check that out if you have one of those high salaries. The other one that I do want to talk about is the Tier 4 salary cap. Now, when the state created Tier 4, it was this big act called the Public Employees Pension Reform Act, and it happened in 2012, took effect on January 1st, 2013. They created Tier 4. They also capped the retirement allowance on as annual dollars on how much Acera is allowed to include for calculating your retirement allowance. And the cap is based on the Social Security wage index limit, so it does increase every year. But you'll see that the cap for general members is 155,081. For safety members, 186,096. That's for this year. It'll go up again next year. But That means that if you have a higher salary than that, we can't use any more annual dollars than that to calculate your highest average monthly salary. So it does limit your highest average monthly salary amount in the formula for you. On a inline basis, while you're working, what that means for your retirement contributions is that when you hit that cap during the year, let's say you hit it in October, for the rest of the year, the calendar year, Acera will system will automatically stop taking out retirement contributions from your paycheck. So you'll have a higher paycheck for the rest of the year, and it will give you a little additional money to save in your 457B account if you so choose, or however else you save it additional money. And then on January 1st, it kicks back in and you start paying into Acera again. Okay, at this point, let me show you how to get a precision retirement benefit estimate for your specific retirement situation. Because we talked a lot about in general how your retirement is calculated, but let me show you kind of the culmination of all that, which is your specific benefit estimate. So all you do is you go out to our website and you click the login button. So you go to acera.org, click the login button, um, and you can log into your account on our website. I showed you earlier how to enroll in the new member portal and how to get the PIN. So let's assume that you've already done that. And once you're logged in, you go to this link right here, estimate a benefit, and it will show you this estimate a benefit tool. Okay, now I'll zoom in here so you can see it a little bit better. It's going to ask you for a couple of dates. Okay, so it's going to ask you for a separation date and a payments begin date. The separation date is your last day on payroll. So whatever you plan for your termination date from your employer is, that's what you plug in here. Your payments begin date is your first day of retirement. If you are planning on going straight from active work into retirement, these would be two consecutive dates, just like in the example here. If you are planning on stopping work and deferring your retirement to a later date, then you can plug those in here, just like that, whatever your plan is, and it will give you a benefit estimate for that scenario. Okay. So you can put in beneficiary information here. If you have already designated a beneficiary for your as your Acera beneficiary for in the event of your death prior to retirement, you will see that beneficiary pre-populated here likely. If that's the case, you can just leave them alone. But definitely check the date of birth because some of the dates of birth are incorrect in the database, and if the date of birth is wrong, it will throw off the calculations. Okay. I recommend not checking any of these boxes because it will give you a nice conservative estimate so you're not disappointed with your final retirement allowance amount once you receive it, and then hit generate, and you will end up with this PDF retirement benefit estimate from Acera. So I'll just zoom in here so you can see it a little bit better. This box right here on page 1 gives you an estimate of your future monthly payment from Acera in this column. And you'll see that there are 5 retirement allowance options here, the unmodified option and options 1 through 4. So I'll talk more about those other options in a little bit. For right now, you can just look at the unmodified option because that's pays the most to you. That pays the highest benefit if you choose the unmodified option. Okay, and then page 2 tells you a little bit more. It tells you what the numbers are that it used to actually calculate that estimate, including the date range that it's using, that it's determining for your final compensation period. It tells you what your average monthly salary is that it used to calculate based on your salary that it already has and the years of service credit and your age. And then, actually, I don't think I have screenshots of it. On pages 3 and 4, it will actually break down all the pay periods that it's using to get this average salary, and it will show you if you sold vacation during those pay periods, if those are actual pay periods in the past, and you'll see some projected pay periods for the future, depending on how far away your retirement date is. So if you do that, you can pair that with your worksheet, which is again at acera.org/worksheet. You can plug in the amount of the precision estimate you get from the PDF. I just recommend just saving the PDF somewhere on your device, and your account will actually keep a record of all these estimates that you made as well, so you can access them later. Okay. So that is the best way. You'll note that that didn't take very long for me to talk about that, just to show you some screenshots of that. When you get in there, you'll see it's super easy. It takes like 1 minute to do. Um, so that's the best way to do it. That system is available 24/7. It's a precision way to do it. We do offer you the ability to request us to do the estimate for you. We have a form on the website, the retirement estimate request form on our forms page at acera.org/forms. So we will do it for you, but there's a wait time for that because we get a lot of those requests. So you'll go into a queue and then we'll send it to you in the mail. So it does take some time to receive that. Whereas if you log into your account, it's pretty much instantaneous. You can have an estimate in a few minutes, and you can do as many of them as you want I mean, there's no limit on how many of those you can do. And it uses the same software. When our staff does it for you, they use the back end of our software, but you're seeing the front end for the members on the member portal, but it all connects. It's all the same numbers. So you get the same result. Okay, so let me help you verify your retirement eligibility. We're talking about this date on the pension milestone chart. Some combination of your years of service and age gets you to retirement eligibility, and you have to at least achieve that to be eligible to actually retire from Acera. I'll show you first the slide for tiers 1, 2, and 3. On the next slide, I'll show you the requirements for tier 4. Now, there are 3 different combinations for tiers 1, 2, and 3 that get you to retirement eligibility. Okay, so you have 3 options here. Option 1 is you are at least age 50, you have at least 5 years of service credit with Acera, and you have at least 10 years of membership. Now, options or tiers 1, 2, and 3 all closed more than 10 years ago, so everyone in those has at least 10 years of membership. So you don't have to worry about that. Just look at you're at least age 50, you have at least 5 years of service credit, you're eligible to retire. So it's actually, you don't need that much service credit and that high of an age to actually retire. Option number 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit and retire at any age, even if it's younger than age 50, that you would need for option 1. Option number 3 is that you can have any amount of service credit, even if it's less than the 5 years you need for option 1, and you can retire at age 70. So if you had only 4 years of service credit, you could retire at age 70 and draw a lifetime pension starting at age 70 based on that 4 years of service credit. So those are your 3 combos that get you to retirement eligibility. I think probably 99% of people fall under option 1. Okay, so that's tiers 1, 2, and 3. Tier 4, you have 2 different combinations that get you to retirement eligibility. Option 1 is as a general member, you're at least age 52. As a safety member, you're at least age 50, and you have at least 5 years of service credit, and you can retire. Option number 2 is that you can have any amount of service credit, even if it's less than the 5 years you need for option 1, and you can retire it at age 70. So not too complicated, that topic. And so hopefully you all are eligible to retire since you're planning on retiring soon, since you're watching this presentation. Okay, now if you want to, you can record your retirement eligibility date. You don't have to. If you already know it's well past, don't even worry about it. Let me help you choose your retirement date. Moving on to the next section. We're talking about this day right here. This is a date that you choose. So again, on the milestone chart, this is your first day that you start collecting your retirement that you've earned throughout your career. And there's kind of six things you want to think about when choosing the best day to retire. So let me go through each one of these individually. The first is regarding will you have enough income to retire? It's a little obvious of a thing to say, like, it's a good idea to just go ahead and take a little peek into the future, get that retirement estimate from a Sarah, see how much you're going to collect in retirement to make sure that you can maintain your standard of living, or at least you can live in a way and change plans if it's a little bit less than you thought. Um, you could, move to a different area that's less expensive. You could work a little bit longer. So it's definitely good to do those projections in advance. It's also good to factor in how much you have saved additionally, especially if you have a deferred compensation account. It's also good to factor in how much Social Security is planning on paying you. So I recommend going out to the Social Security estimator and getting an estimate from them on how much they're planning on paying you when you're eligible to first start receiving that at age 62, or if you wait and take it at a later age. You can also, if you want, compare your retirement income to your post-retirement expenses. So if you like to get pretty granular, you can do that. That's purely kind of a bonus. If you don't want to do that, a very rough rule that financial planners say is that your post-retirement income should be at least 80% of your pre-retirement income, meaning what you are getting from a combination of a SARA, Social Security, and any disbursements that you take from your personal savings, like your deferred comp account. Those should all be at least 80% what you're getting per month. Those should all be at least 80% of what you were earning per month while you were still working in order to maintain your standard of living. That's just kind of a real rough rule that people go by if you don't want to like get as granular as looking at expenses and all that. And we have a an article that goes more in depth on this on our website. If you go to acera.org and you scroll down to this section right here, ready to retire, and there's some, different topics here. One of them is estimating your retirement income. And you can walk through this article and it kind of takes you through it step by step and gives you the links out to the Acera login. There's a video here that we just created recently that walks you through estimating your pension using the benefit estimate tool. There's links out to the Social Security estimator, links out to the deferred comp login, and there's more info there. There's even like a retirement calculator, kind of a bonus thing from AARP, and a budget worksheet. It's kind of a bonus if you want to do that, if you want to walk through that. Okay, so that's item number one when choosing your retirement date. It's just, thinking about your getting a general sense or as specific a sense as you want to get about your retirement situation. Number two, age factor percentage dates. Now, you may want to be cognizant of these four dates. Okay. Remember, I told you when we were talking about the age factor percentage that every quarter year you age, you go up one notch in that age factor chart. You get a slightly higher age factor percentage, as long as you haven't yet reached the maximum age for the maximum age factor for your tier. So if you haven't, every quarter year that you age, your retirement allowance is going to go up um, by anywhere from 1% to 1.9% just by aging a quarter year. Okay. So let me just give you an example of that. If your birthday is January 15th, because it's based on your birthday, um, one quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters after your birthday is October 15th. Okay. So if you were thinking, like, let's say that you were considering as a person with a January 15th birthday who is younger than the maximum age for your tier to get the maximum age factor percentage, you were considering retiring on July 14th. Well, you can see that you don't want to do that. You want to just push it out one more day. Retire on July 15th, work one more day. get over that next age factor percentage, and you get a slightly higher age factor percentage, and it's the same with all of these. You just make sure that you retire at least on that day or right after. And your retirement allowance increases immediately by anywhere between 1 and 1.9% just by getting to that next age factor percentage. Okay. And so, just to show you the age factor percentage chart here, if you're in whatever tier you're in, if you're younger than the age with the blue box, that means that you should be cognizant of these dates, of these 4 dates based on your birthday. Okay. Now, if your birthday, one more thing I want to say about that is if your birthday is, actually, 2 more things. If your birthday is on a day of the month, like the 31st, where the next 3 months from now, the 31st doesn't exist, then what you're looking at is the day before. So, like, for example, August 31st, I think. You go November 30th would be the next quarter date. Okay. There's no 31st in November. Um, so that's how that would work. And the other thing that I want to say about that is that, well, I'm not trying to tell you that you need to retire on one of these days if this was your birthday. I'm just saying that don't retire right before one of these days. Like if you're going to retire halfway between here, like you want to retire, February 30th. Well, I'm not telling you you got to stick around and work until April 15th to get over the next, just go ahead and retire when you're ready. February 30th is fine. It's just that if you were going to retire on April 14th, like I would say don't do that. Retire on April 15th and you get an immediate increase to your retirement allowance when we calculate it in for the rest of your life. Okay, at this point, I want to talk about the cost of living adjustment because it's a good time to talk about it. I'll give you a few more details, and there's a timing issue with it in terms of choosing your retirement date. Okay. So the cost of living adjustment, you'll remember to the beginning of the presentation, it's a guaranteed benefit. It's a vested benefit. It's an annual increase to your retirement allowance that you get every year. It's a percentage increase, and it's based on the amount that prices go up in the Bay Area, the CPI, which is a measurement of inflation. So if the CPI goes up a certain percent, let's say it goes up 5% December to December, that coming April 1st, when we post the COLA is going to be, we're going to be looking at 5% increase, except the law tells us to limit it for tiers 1 and 3 to 3% and for tiers 2 and 4 to 2%. So that's the maximum annual COLA you can get. But what we do to make up for that is we save any percentage points that we can't pay you that year. We save it in what we call a COLA bank. For a future year, if inflation is less than whatever the maximum is, let's say the next year rolls around and inflation is 1%, then we would give you the 1% plus we would take percentage points that you have banked and pull them out of the bank to get you up to the 2 or 3%. So the bottom line there is that if you've already been retired for a few years, you tend to bank percentages. So you tend to just get the maximum annual limit every year. So you can pretty much expect to get a 2 or 3% increase to your retirement allowance every year after a few years, at least, if not in the first year. Now, the reason I'm talking about this now within the subject of choosing your retirement date is because of this April 1st date. The cost of living adjustment is posted for all retirees, everyone in retired status, as of April 1st each year. Okay. Now, if it's not your first year of retirement, for the rest of your life, it's just going to happen on April 1st. But when you're approaching retirement and you are already you're thinking about retiring in the spring, for example, a lot of people will have this date in mind because if you retire on April 1st or slightly before, or however much before, you will get the cost of living increase for that year, whatever it is. If you retire on April 2nd, or anywhere, the rest of after that, you will miss the cost of living increase for that year. But next year, when next year's cost of living increase comes around on April 1st, you'll get it, and every year after that. But it does mean that if you're thinking about retiring in the spring and you run the numbers, It's usually advantageous for you to retire in March or as of on April 1st. That can be your first day of retirement, April 1st. Than it would be for you to retire on April 2nd or in the rest of April or perhaps even in May. So that's why March is our biggest retirement month because people are already going to retire in the spring and they want to retire, before the COLA to get the COLA because they would make less money if they retired on April 2nd or for the rest of April or in May. Okay. Um, for the rest of the year, there's not really a timing issue. Like if you're going to retire in January or December, September, August, July, you have to think about this. Okay. This is just for if you're going to retire in the springtime, it's a good thing to be cognizant of. So what you would do is you could, if you want to test this out, um, you can, run an estimate for April 1st and you can run one for April 2nd, and then you can increase the April 1st one by the 2 or 3%, and you can note for yourself that you would get more retiring on April 1st. Okay, so looks like there's a healthcare question, so I'm going to save that for when we get to healthcare, which is not the next topic, but the one after that. Okay. So, the fourth item that you may want to consider when choosing your retirement date, this doesn't apply to everyone, but this may apply to a few people, is sometimes there is a conflict between the increase due to the age factor percentage and the increase due to the cost of living adjustment if you're thinking about retiring in the spring. So in this example, I'll stick with the January 15th birthday example. This is a general member, they're age 54, and I just say that because they have not yet reached the maximum age factor for their tier. So every quarter year they age, their age factor is still increasing. They're thinking about retiring in the spring, and they're trying to choose, should I retire April 15th, which is one quarter after my January 15th birthday, or should I retire April 1st? If I retire April 15th, I would get the age factor increase for having aged one quarter year, but I'm going to miss the cost of living adjustment that I would have gotten had I retired a couple of weeks ago on April 1st. Or should I retire on April 1st, in which case I would miss the age factor increase that I would have gotten had I waited a couple of weeks and retired on April 15th, but I will receive the cost of living increase for being in retired status on April 1st. Which do I choose? Well, you probably already know the answer because I already showed you the percentages. I already mentioned them. If the cost of living adjustment is the maximum for that year, and we always post this, we always know this the first week of February, we post it on our website, and I think we may even send out an email about that. But we definitely post it on our website, post it on the front page of the website every year, first week of February. Um, If the cost of living adjustment is the max, you're going to want to go with the cost of living adjustment in that case because you would get a 2% increase or a 3% increase if you're, tier one, tier two and four is 2%, tier one and three is 3%, which is going to beat out the age factor increase, which is going to be anywhere from 1 to 1.9% increase. Okay. You don't have to take my word for it. If you are in this dilemma, I very much recommend you do two benefit estimates in this scenario. You run one for April 15th, you run one for April 1st. Okay, now the April 15th one, the math is already going to be baked in. You're already going to get the H factor increase. Okay. The April 1st one, you're going to have to do a little math. And so you're going to have to take whatever the projection is that it's giving you and you multiply it by the increase. So for example, if you want to see the effect of a 2% increase, you would take your retirement benefit estimate number and you would multiply it by 1.2, I'm sorry, 1.02 to get the effect of a 2% increase. And then you just do whatever number is the biggest. Take the biggest one. Do that scenario because we want you to get the highest retirement allowance that you've earned because you've worked really hard throughout your career. Okay. Last two items on choosing your retirement date. If you want us to do that automatic conversion of unused sick leave to service credit that I was talking about in the first half of the presentation, all you want to do, and it's not hard, you just want to make sure that you go straight from active work into retirement by having your last day on payroll and your retirement date be 2 consecutive calendar days. Okay. So your last day on payroll, this is your last day of work, your termination date, there's different terms for that. But this is the date that you write in on your letter of resignation to your employer. Your retirement date, this is the date that you write in, that you type in on your retirement application to Acera. And if you do that, and these are 2 consecutive dates, that means you are spending no time as a deferred member. If you spend any time as a deferred member, even one day, you lose all of your sick leave, so you don't get the boost. So you just make sure these dates are consecutive dates and you're fine. And we'll do that conversion for you automatically. And there's one more little detail about this that I want to mention. This is the last thing. You want to retire if, and this again is if you're trying to do the sick leave conversion. If you're not trying to do the sick leave conversion, if you're going to stop working and defer your retirement to a later date, don't even worry about it. It's totally fine. But if you want us to do the sick leave conversion, you retire on a day where you are scheduled to work on the day before. And that day that before should be a non-holiday, a non-regular holiday. Okay. So it's okay for you to be on leave on that last day of work. Like you could be on sick leave, floating holiday, vacation leave on this day, totally fine. It's just you're on payroll. You're still on payroll this day, and this day is not a holiday. It doesn't have to be a Friday. It just has to be a day that you were scheduled to work. So let's say that you work Monday through Friday, like many people. Well, your first day of retirement should not be on Sunday or Monday because you don't work the day, you're not on schedule the day before that. Okay. Now, if you work in law enforcement or healthcare, obviously, or sometimes, I won't say obviously, but sometimes and often, I think often is what I meant, you maybe don't have a regular schedule. Maybe it changes, maybe it shifts around. So, what you might want to set is a retirement week. So you target a week to retire, and then when it gets closer to the time, when you see what your schedule is, then you can choose your retirement dates, submit the application, and make sure that the day that you retire is a day after you are scheduled to be at work. And then we will do the sick leave conversion for you on a 2-to-1 basis to service credit. Okay, so at this point on your worksheet, if you want to just go ahead and record whatever retirement date you have in mind, your separation date, now you know these should be 2 consecutive days. So you can just write all that in. And I did want to point out one thing about the letter of resignation. When you go to retire, and I'm going to refer back to this section again in a few minutes, but we have this whole section here, which is prepare to retire. It's this one right here. You can also find it under members, preparing to retire. And the last step on here is the applying to retire, and you'll find out more about this when you're working with when you're working with your retirement counselor. But I just wanted to point out that this is the page that has the electronic retirement packet with all the forms. And there are more steps here. One of the steps is notifying your employer in writing of your employment separation date. And there is a letter of resignation template on there. And it's a Word document, or you can just, here's the text of it, you can just copy and paste it. And so you can plug in your own dates, your termination date and stuff. Okay, so speaking of applying to retire in the electronic retirement packet, let's walk through that in the next section of the seminar. What does the retirement application process look like? Step one is we want you to go through that preparing to retire section. So yeah, I said I was going to refer to it. That was actually the next thing. So again, to get to it, it's this section here. You go to acera.org. You can just type in acera.org/prepare. or it's under members. You can go down to preparing to retire, or it was in this berry colored section, prepare to retire. All goes to the same place. This is a chronological step-by-step series of posts that we want you to read and some things that we want you to do. Now, you've already done a bunch of these. We've already verified your retirement eligibility. We already talked about how vacation pay affects your pension. You're already attending a pre-retirement seminar right now. So you've already done a lot of this stuff, but we do want you to go through the section, and then I'll talk about these last three steps. We talked about choosing your retirement date. Um, so then the next three, we'll go through these last three steps in let me go back to the step-by-step process here. Okay. So that's the first item. Go through that preparing to retire section. Step number two, set up a ready to retire counseling session. So we want you to set up that session in the 3 to 6 month period before your retirement date to fully prepare. But if your retirement is closer than that, don't worry. We can probably get you in. So don't worry about that. And what happens is you fill out the form, and then our staff will contact you. My colleagues will contact you, and they'll set up a counseling session for the 3 month period leading up to your projected retirement date. And so the shortcut to get there is acera.org/counseling, or it's the third to last item on that preparing to retire page, scheduling a retirement counseling session. And so there's a whole form that you fill out and submit. We do require that you enroll in our Member Direct member portal, and it walks you through that because that's how we communicate with you. Okay. Step number three, submit a retirement application. So once you are in contact with your retirement counselor, they will give you more information and reminders about this, and they'll give you the link. Um, but we do want you to submit that retirement application within the 90 days before your retirement date, and I believe they want you to submit it before your counseling session. That way they can fully go through it prior and be fully prepared. Okay, so submitting the retirement application, going back to the preparing to retire section, it's the last step, applying to retire. I'll talk about this step in a minute. So applying to retire, there's just some info that, we want to make sure that you went through all the other steps. There is detailed info on the 5 retirement allowance options, which I will go through in a few minutes. And then it comes down to your electronic retirement packet. It's all in DocuSign. You don't have to get out pen and paper. You don't have to have a printer, a scanner, any of that stuff. You don't have to get US mail involved. You just click on the DocuSign link, takes you right to the application. Do it all in DocuSign. Okay. And you can see that there are some other forms to fill out there, including healthcare enrollment forms. On your retirement application, you're going to select a retirement date. You're going to select one of the 5 retirement options. You're going to nominate a beneficiary or beneficiaries for your death benefits after your death. You are also going to consider joining a retiree association, which I'll talk about more in just a few minutes. Okay. And then you click submit in the DocuSign to submit the completed form to us. We receive it, we process it in our database, we take note of your retirement date, and once your retirement date passes, you're retired. It's going to be amazing. You've earned it. You have worked super hard for the residents of Alameda County for many years, however many that you've worked, and you've earned it. So we really hope you enjoy your retirement, and let us know how we can help you make it the best. Okay. And we love to see people retire because, that's what we do. Okay, so at this point, going back to your worksheet, all you need to do at this point is fill in, now that you know that your counseling session should be scheduled about 3 to 6 months before your retirement date. If you already have a projected retirement date, just subtract 6 months, put that date in here, and then don't stop there. Go to your calendar, your electronic calendar, or however you keep track of reminders, plug it in there to remind yourself to fill out that counseling session form. Okay, now going back to the step that second to last step that I said that I was going to get back to, consider joining a retirement association. On the retirement application, there is a section where you can check a box for joining either or both of these retirement associations. So I just like to mention that these exist and what they do for when you get to that spot on the retirement application. There are two retiree associations they're completely associations of Alameda County retirees. Their entire mission for both of them is to advocate for Alameda County retirees when you join. They publish newsletters, they hold social events. There's two of them. ACRE is Alameda County Retired Employees. They are affiliated with the SEIU Local 1021 Union. The dues are an incredibly cheap $3 per month. REAC is Retired Employees of Alameda County. They're unaffiliated. The dues are an incredibly affordable $2 per month. And the reason that we have you select this on your retirement application is to make it convenient for you if you want to participate in either or both of these. We will deduct the dues out of your retirement check and send it over to those organizations as a convenience to you to make it super easy. So all you got to do on your retirement application is check the box. They're both great organizations. REAC holds two luncheons a year in the spring and fall. Acre holds a holiday luncheon in December. And like I said, they have the newsletters, and all they do is advocate for you. I go to all their board meetings. They come to all of our board meetings, so we keep a really tight relationship with them. There's more information at acera.org/retiree-associations. Okay. Your first retirement check, once you're retired, once that date passes, you can expect within 4 to 6 weeks after your last employer's paycheck. 99.9% of the time these days, our retirees, their first check is a 100% payment. We've already solved any major issues prior to that, and that's one of the reasons we like you to sign up for the counseling so far in advance is we get all the issues solved in advance and start paying you your 100% payment immediately. Occasionally, though, if there's a major issue, such as any of these reasons, we will issue partial payments, about an 80% payment, until we get the issues resolved, and then we'll get you up to the 100% payment and issue you any retro payments for any less than 100% payments we had to make. Okay, so let me talk about your 5 retirement allowance options. When you go to fill out your retirement application, you're going to see a section where you have to choose one of these 5 options. And they all do a little bit different things for your retirement allowance versus what your beneficiaries would receive after your death. So it's good to know exactly what these do because you only get this one opportunity to make that choice on that retirement application, and you can't change your mind later. There is one scenario where I believe if you do the regular retirement, also known as service retirement, and then you at the same time are applying for a disability retirement because you're permanently disabled and you can no longer perform your job duties, that disability retirement process can take up to a year. So while you're waiting for that to go through, you're in the regular retirement. I think that if you are awarded the disability retirement, I do believe you can change your option for the disability retirement at that time. You would want to check with your disability counselor that you're working with if you're going through that process, just to make sure I'm correct on that. Okay, so let me tell you about each one of these options. Now I'm going to throw up a slide for each one of the 5 options. It has a lot of text on it, but I'm going to walk you through it. The top is going to talk about the title of the option. The top of the table will tell you about your retirement allowance that you receive as an Acera retiree for the rest of your life. The bottom info is going to tell you about the benefits available to your beneficiaries after your death. Okay. So this first one, the unmodified option, this pays to you, the retiree, the maximum retirement allowance of any of the 5 options. And that's why the vast majority of people select this option is because it pays the most. Now, at the time of retirement, you select a beneficiary. And a beneficiary, that word just means somebody who gets benefits. And your Acera beneficiary is the person that you designate to receive your Acera death benefits after your death. Okay. So you retire, you start receiving the retirement allowance, and then after your death, your beneficiary, your qualifying beneficiary would receive a 60% monthly continuance. Now, continuance, that just means a continuing monthly payment for some time um, after the payments conclude of your retirement allowance because of your death. Okay, so we're paying a continuing payment to your beneficiary. And if they are qualified, if they are a spouse, state registered domestic partner, or Alameda County domestic partner, it's a lifetime benefit. They would receive it every month for the rest of their life. Now, you have to have married them or registered them as a domestic partner within um, at least 1 year before you retire in order for them to qualify as a continuance beneficiary for the unmodified option. Now, if you don't have a spouse or domestic partner, but you have a minor child or minor children, you can designate them for a continuance, but under the unmodified option, it's not a lifetime benefit. It's a temporary benefit. So they wouldn't receive it for the rest of their life. They would receive it until age 18, at which point it would stop. Unless they enroll as a student in an accredited school full time, and then it can continue until age 22, at which point it would stop, as long as they maintain that enrollment. But it will always stop if they marry or register a state domestic partner. Okay. Now, let's say that you get to retirement. You want to choose the unmodified option to have it pay the most to you, but you don't have a spouse, domestic partner, or minor children. Can you still select the unmodified option? Absolutely. And you can even name a beneficiary. But your beneficiary would not be eligible for a monthly continuance. They would be eligible for a lump sum payment, which is a one-time payment all in one lump sum. And what they would basically receive is a refund of your contribution account. Okay. And it depends on how much money is left in there, depends on how much they get, because what we're going to give them is all of your employee contributions that you've paid in to Acera throughout your entire career. So that lump amount plus all the interest that we have paid on top of that contributions because we've invested them, minus each and every one of those retirement payments that we paid you while you were a living Acera retiree that we paid you in your retirement allowance. And one thing that I'll note is that there the contribution account is going to be exhausted within the first 3 to 5 years of retirement. So if you died after that first 3 to 5 years of retirement, we would have already paid you out all the money, the contribution, employee contributions and interest. So there would be no balance left to pay the lump sum beneficiary. Okay. Uh, there is kind of a side note here, which like that's good news in a way to everyone who selects the unmodified option because what it means, the implication of that is that everything that you paid into Acera throughout your entire career, we give you all that money back within your first 3 to 5 years of retirement. And then your payments do not stop there, they continue for the rest of your life. And that's because that's just the way the pension works. And so everything after that is kind of like this amazing bonus you get, but it really isn't because that's just how the pension system works. It's a guaranteed amount of money that you can count on for the rest of your life. Okay, so that's a little aside. Coming back to the unmodified option, one more thing I want to say about this is that there's a scenario where at the time of retirement, you had a qualifying beneficiary for a monthly continuance that you named on your retirement application. You retired, you started receiving your payments, and then your beneficiary dies before you do. If that's the case, then you can name a new beneficiary at that time, but not for a continuance. The only time that you can name a beneficiary for a continuance is at the time of retirement on your retirement application. So any beneficiary you would name after that would only be eligible for a lump sum payment. Now, I say that your balance of your account would be exhausted after the first 3 to 5 years. There are other amounts that they would receive. There's the $1,000 lump sum payment. If you enroll in our healthcare plans, you pay those premiums a month in advance. We would refund that. Also, there's a partial month of your retirement allowance that we haven't paid you yet by the time of your death. They would receive that. So it is good to have that lump sum beneficiary if you don't have a continuance beneficiary, and they would receive some amounts. Okay. So, one more thing I want to say about that is that there is a scenario where you retire at the time of retirement, you're not married, and then you retire and you get married later. You can name your new spouse or domestic partner, if it's a domestic partnership, for as a beneficiary, but again, only for lump sum payments. So those are pretty much all the details of the unmodified option. Okay, moving on to option one. The subtitle is Lump Sum to Beneficiary, and that is because this is the only one of the five options that never pays a continuance payment to anyone ever. The only thing that is ever paid out to a beneficiary if you select option one is a one-time lump sum payment. Okay. Now, what this does to your retirement allowance is it slightly lowers it from what the unmodified option would have, what you would have received from the unmodified option had you selected the unmodified option. It's a little bit less. You'll see it when you run your estimate, it'll be like $10 or $12 less or something like that per month. Okay. And then what it does is it extends the time that there's a balance of contributions and interest left in your contribution account. Um, Instead of 3 to 5 years, it's 10 to 12 years. So if you were to die within that first 10 to 12 years, there would be a chunk of money left in your contribution account to pay out to the lump sum beneficiary, in addition to those other small amounts that I mentioned. So the people who would select option one are the people who are interested in the unmodified option, who want to get the maximum amount as a retiree, but are okay with taking a slightly less amount in order to name, because they only have a lump sum beneficiary, in order to extend the chance that that beneficiary would receive more of a one-time lump sum payment. If you do have somebody who qualifies for a monthly continuance here, you probably don't want to select option one because in most cases, a continuance will pay them way more over their lifetime on average. That's option one. Option number two, the subtitle is 100% to beneficiary. Okay, now you'll note the unmodified option was subtitle was 60% to beneficiary because it paid a 60% continuance. Option number two pays 100% continuance. That's one of the two main things that it does. It pays 100% monthly continuance. Whatever your retirement allowance was at the time of your death, including all of the cost of living increases that you've already received, um, that will become your beneficiary's monthly continuance payment, and it's a lifetime payment, okay, in all cases for all beneficiaries. So they'll get that amount plus their own cost of living increases every month for the rest of their life. Okay, so that's the number one benefit that people choose for this. The number two is that the beneficiary can be anyone. So it doesn't have to be spouse, state registered domestic partner, Alameda County domestic partner, minor children. It can be anyone. It can be adult children, or a niece or a nephew or a family friend, or literally anyone. Um, only one person. Options two and three, you can only name one person as a beneficiary. Option four is where you can name multiple people. We'll get there in just a minute. Okay. Now, let's talk about what it does to your retirement allowance. It does not pay as much as the unmodified option because we are expecting to pay the beneficiary more. We're going to reduce what we were paying you while you're a living retiree. And and that calculation happens at the time of retirement. So immediately upon retirement, you are not getting as much as you would have gotten on the unmodified option, but you are um, leaving 100% continuance to your beneficiary. Now, if the beneficiary dies before you do, let's say that you're you retire, you name them as a continuous beneficiary, you start taking your retirement allowance, but they die before you do, which was not the plan. The plan was for you to die first, and then they would be your continuance beneficiary. Um, you you can name a new beneficiary again, but not for a continuance, A, and B, we don't recalculate your retirement allowance because your beneficiary did not live out their, average life expectancy. Um, that's just the way that the law tells us to run the system, to keep the system whole. So that's, one consideration. Another consideration is that the reduction of how much less it pays you from what the unmodified option would have paid you is based on the life expectancy of your beneficiary. So if you name somebody significantly younger than you, they have a much longer lifespan. We're going to expect to have to pay them a longer time. So we are going to reduce what we pay you because we're going to expect to have to pay the beneficiary more. The final caveat here is that if you name someone as a beneficiary who is not your spouse and is more than 10 years younger than you, the IRS may not let us pay them 100% continuance. It may be a 95% continuance or a 97% or an 89%. There's a reduction calculation. The calculation is super weird. Um, if you want to know more about it, if you actually want to dig into that, if you go out to that preparing to retire page, um, and you go down to the last thing, applying to retire, the shortcut is just acera.org/retire. We do have more details about the different options. So you would scroll down to option number 2, and there's a link here, IRS limit for non-spouse beneficiaries, and it tells you what the calculation is and how to do it. It's very weird, and it it's beyond my ability to understand. Okay, but that's how that works. Option number 3. So that's option 2. Okay. Those are all the details for option 2. Option number 3. The subtitle is 50% to beneficiary, and you can kind of see how this is progressing on these slides. That means that the continuous beneficiary is going to get a 50% continuance. Again, the beneficiary can be anyone. Option 3 is basically exactly the same as option 2, except it's paying the beneficiary 50% continuance. So whatever your retirement allowance was at the time of your death, your beneficiary gets half that as their payment for the rest of their life. And again, the beneficiary can be anyone. All the same rules apply regarding if your beneficiary dies before you do. One thing to note is because the beneficiary gets paid less in option 3 than in option 2, you get paid more. So your retirement allowance for option 3 would be larger than had you selected option 2. Also, that IRS thing doesn't apply here because the reduction from the 100% is never more than the 50%. So 50% continuance is what it will be in all cases. Option number 4, the final one of the 5 options. Option number 4 is pretty much exactly the same as options 2 and 3. Okay, it allows you to name anyone as a beneficiary, and it allows you to name them for a lifetime continuance, and it pays less than the unmodified option, and the reduction is based on your beneficiary's life expectancy. Now, what it does do is it gives you a lot of different options. It gives you a lot of leeway in order to choose your own specific beneficiary continuance situation. You're not stuck with only having one beneficiary like in options 2 and 3. You're not stuck with only 100% continuance or only a 50% continuance. You can name any continuance you want as long as it's not more than 100%, of course. So if you had and you can have multiple beneficiaries. That's the second thing it does. So let's say that you had a niece and a nephew. You can't name multiple beneficiaries um, under options 2 and 3. So you could leave each one of them 50% continuance as long as the total doesn't add up to more than 100%. Or if you run the numbers and because at a 50% continuance, which adds up to 100% continuance, you would have a pretty steep reduction to your retirement allowance. If you can't afford that, you could leave them less. You could leave them each a 10% continuance, which would add up to a total of 20%. Or you have a nephew and you have a brother. You could leave the brother 30%, you could leave the nephew 10%, or however you want to do it. Whatever combination doesn't have to even have to be a percentage. It can be a dollar amount that you name. You could have, three nieces. So you can mix and match here with this. It gives you a lot of different latitude to, tell us who you want to leave as a continuance beneficiary and what you want to leave them. So that's pretty much it. That's kind of all the details about the five options. One more thing that I like to point out to people is that people do ask about leaving continuances to adult children. Um, and what I like to say is that that is a really beautiful gift that you would want to leave to your adult child. Um, it's a really beautiful sentiment. You want to leave something to them that they can continue to collect for the rest of your life, based on the hard work that you did here. So that's a really nice thing to want to do. That's a really nice gift. Um, Another nice gift to leave to them before your death, actually, is your financial solvency for the rest of your life. So they don't have to worry about you financially. So all I'm saying is if you want to leave something to people because you have a lot of different ways to leave continuances to people among these five options, just make sure that what it's reducing from the unmodified option isn't making it hard for you to live out the rest of your life comfortably, and be able to be able to afford the rest of your life comfortably. Because then if people have to worry about you financially, then that's, an extra burden. And in many cases, they would probably rather you, be able to live your life comfortably based on what you earned than, receive a continuance. And in most cases, your adult children have many earning years ahead of them as well. So, they can continue to work on their own situation. Okay. Now, here's another screenshot again that you've seen already of the retirement benefit estimate PDF, and I'll zoom in again to show you the your estimated monthly benefit table in here. And now that I've explained each one of the options, some things in here might become illuminated. You'll note that the unmodified option, and if you're looking at the member monthly benefit column, this is your estimated retirement allowance for the rest of your life, depending on which option you select. So you'll note that the unmodified option is the biggest number on the page. It pays the most of any of the other options. You'll note that the beneficiary continuance for the unmodified option is 60% of this amount. You'll note that the option one is a few dollars less than the unmodified option, and it never pays a continuance to a beneficiary, so it's grayed out. And in this example, let's see, how many dollars is that? It's about $3 less per month than the unmodified option if you selected option one to extend the time that the person could get a lump sum payment. In this example, option number two, you'll note that the amounts are the same. Your retirement allowance estimate is the same as your beneficiary's allowance estimate because it pays 100%. You'll note that option three is a larger number than option two because the beneficiary gets less, you get more in this. And you'll note that the beneficiary amount is 50% of this amount. So it all kind of makes sense with what this estimated monthly benefit table is telling you in your benefit estimate. Option number four, there are so many different combinations that you can do that we have not yet been able to program that into the calculator. So you will have to work with your retirement counselor once they, during your counseling session to get estimates for that if you want to. So we do offer that. We are working on implementing this, but it'll probably take a year or more to implement that. Okay. Last major section, understanding other benefits. So this is the point where I move from talking about all of the guaranteed benefits to moving into the subject of non-guaranteed benefits. So I mentioned that the vesting means guaranteed. These are also known as non-vested benefits. And And don't confuse the benefit that term with the idea that somebody who's not vested is going to get these. No, what it means is that these are just simply not guaranteed. Okay. These are extra additional benefits that Acera offers. And the reason that we're able to do that is because back in the 80s, the county decided that the retirees of the county needed some extra money to be able to pay for health care and other things like that in retirement. So they started this reserve fund called the Supplemental Retiree Benefits Reserve, and Acera runs it. Okay. Basically, you can think of it as a reserve medical fund, sort of. Acera's Board of Retirement is in charge of it. So we have our own separate board. They're in charge of it. And they are tasked with like determining who gets paid out of this. All of this money that's in this fund, there's $1.2 billion in this fund currently. All of the money by law has to get paid out to retirees. So the Board of Retirement determines how it gets paid out, and their whole goal is to keep the fund sustainable into the future. The fund does receive interest payments when the fund earns money. It's all invested, so it's growing. But we are paying a lot of payments out of it, and so the board keeps track. They hire an actuary to keep track how much money is coming in, how much money is going out, and they will make adjustments to the rules around this periodically to ensure the fund stays sustainable. Okay, so that's just something to remember in retirement. These are not guaranteed benefits, these are extra benefits. Acera Alameda County offers a higher level of these benefits than any county in California because of this reserve fund situation that other counties don't have. But these are subject to reduction, elimination. Elimination usually doesn't happen. The fund is very sustainable currently, and the board does keep a close, actuarial watch on this to make sure that they can continue offering these benefits. List of benefits currently are a medical subsidy known as the monthly medical allowance, which is what MMA stands for, and there are three levels of it. There's a dental subsidy, pays 100% of your dental premium. Vision subsidy pays 100% of your vision premium. Medicare subsidy pays 100% of your cost to be enrolled in Medicare Part B at the base level. Supplemental COLA keeps your buying power at a certain level in retirement. Very powerful benefit. So I'll walk you through each one of these in detail, but I like to start out with this chart because the board's rules are that it takes a certain amount of Acera service credit to start qualifying for these benefits, and that's one of their ways of keeping the fund sustainable. You have to, supplemental cost of living adjustment, that's the only one that doesn't require any service credit specifically to qualify. All the other ones start at 10 years of Acera service credit. So you have to at least achieve the 10-year service credit mark. Reciprocal service credit doesn't count. Only Acera service credit counts for just this set of non-guaranteed benefits. You don't have to retire from Acera last. You could retire from reciprocal agency last, but you do have to have this amount of Acera service credit to qualify. 10 years gets you the first level of the medical subsidy, and it gets you the dental, vision, and Medicare subsidies. And then if you do achieve 15 or 20 years of Acera service credit, you do get an enhanced monthly medical allowance. So let me talk about the monthly medical allowance first. The monthly medical allowance is a subsidy that helps you pay for the cost of your medical coverage in retirement. Because when you retire and you stop working for your employer and you shift over to being an Acera retiree, you're not going to be able to be on your employer's medical plan after that. I mean, you can take the Cobra, but it's not going to be as cheap as the Acera uh, plans in most cases. Okay. So we'll get you right into a medical plan on your first day of retirement, so there's no gap in coverage. And we offer group plans and individual plan options. And so the monthly medical allowance is the subsidy for offsetting the cost of being enrolled in one of Acera's sponsored medical plans. So again, we have group plans, individual plans. If you enroll in a group plan, it helps pay for your premiums. If you enroll in an individual plan, It helps pay not only for your premiums, but also co-pays, deductibles if you're in a deductible plan, if you're in a deductible plan, IRS approved medical expenses. Again, it's not guaranteed. The amount of the monthly medical allowance is set annually by the Board of Retirement. I've been here 17 years. I've never seen them reduce the monthly medical allowance. I've only seen them either increase it each year or hold it the same. And holding it the same is one of the tiny levers that they use to keep the fund sustainable. The retiree is responsible for any costs exceeding the monthly medical allowance. So if the premium amount is more than the subsidy, you have to pay the rest, essentially. The subsidy is not available for anyone besides you, the Osera retiree. So it doesn't pay for any of the cost of anyone else you enroll. You can enroll them, you can enroll beneficiaries, spouses, plus ones, family members, dependents. If after your death, your survivors can maintain enrollment, and so on and so forth, but none of them are eligible for the subsidy. Okay, how much is the subsidy? For 2026, if you retired with at least 20 years of Acera service credit, it's $687.21 per month. If you retired with at least 15 years, it's $515.41 per month. If you retired with at least 10 years, it's $343.61 per month. Okay, so these are the dollars you would have to work with to help to go pay the premiums for being enrolled in the plans. Okay, now I'm going to show you the plans. First, I just want to mention that Acera, once you retire, the entire month of November is Acera's open enrollment. So it's longer than the county's active open enrollment, which is only 2 weeks, which I think is super short. So Acera's open enrollment is the month of November. There are two kind of categories of plan based on your age and Medicare eligibility. If you're not Medicare eligible, which means that generally that you're under age 65, you would be looking at getting into either the Kaiser Permanente HMO or the United Healthcare Signature Value HMO, or an individual plan through Via Benefits. If you are Medicare eligible, which means you're 65 and older, you would be looking at the Kaiser Permanente Senior Advantage Plan or an individual plan through the Via Benefits Medicare Exchange. Okay. So what I'll show you the group plans for the non-Medicare. I'll show you the group plan for the Medicare, and then I'll talk about the individual plans through Via Benefits all at once to keep things efficient. We do publish an enrollment guide every year. This has all the details. This is a 36-page guide. You can get the PDF at acera.org/guide. I'm just going to basically show you the premiums for the plans. Okay, so first off, we're looking at the non-Medicare group plan costs. So if you retire from Acera and you're not yet Medicare eligible, so you're under age 65, and you live in one of these service areas, San Francisco Bay Area, Sacramento, Fresno, Southern California, it's basically the entire Southern California, and Santa Cruz for Kaiser, you have to choose one of these two group plan options. Now, I think this year we are going to look at with the Board of Retirement, we are going to look at expanding that to allow people to choose an individual plan through Via Benefits, even if you live in the service area. But that has not transpired yet. That could transpire for 2027 plan year, but we'll see what happens. Okay. Because the board, decides on all that stuff. For right now, you would be choosing between these plans. And you can see that the Kaiser HMO is the cheapest plan, and it's $1,133.80 per month for just the self premium. And you'll note that the monthly medical allowance, even at the 20-year mark, doesn't get anywhere near covering the cost of that. Let me see here. 687.21 divided by uh, 1 1 through 380. Have to prove I'm not a robot. Okay. Have to choose all of the. Okay, 60%. It pays about 60%. And you can enroll Self Plus One in family. There's a higher premium for that. Co-pays for this plan are $15. Okay, now I just want to mention here how the monthly medical allowance works and how the deductions work for if you enroll in one of our group plans. Okay, so here is a very crude representation of your Sarah check stub. So you have your gross pay, and in this case, it's $4,000. Okay, then if you sign up for one of our group plans, we will deduct the premium from your check and send it over to that carrier as a convenience to you. And then if you're eligible for the monthly medical allowance, we put that back into your check in the same check as the subsidy, and you end up paying the difference. Now, when you retire and you see your actual check stub, you'll see more deductions. Uh, if you enroll in vision and dental, you'll see deductions for that. If you enroll in the REAC or ACRE retiree associations, you'll see those dues come out. You'll also see taxes come out because you're going to owe income taxes on this check because you did not, you paid into Acera on a tax deferred basis, so you will owe income taxes on disbursements. Now, you'll in the additions column, you see this money going in. That is not taxable income. Okay. So all of these subsidies that are paid from this SRBR, they are not taxable. So we have it worked out with the IRS. Accounting wise, it is not taxable income. Okay, so that is how those are the group plans if you're not Medicare eligible, and how the group plan premiums are taken out of your check and the monthly medical allowance put back into your check if you're eligible. And now I'll show you the Medicare group plan costs. This is for the Kaiser Permanente Senior Advantage plan. So in order to enroll in this plan, you have to live in those service areas that I mentioned before. Okay. The premium for the self and the other premiums is way cheaper because Medicare is the federal government's medical insurance system in a sort of medical subsidy system that they have for people who are 65 and older. So they pay a lot of the cost of your care. And what this plan and any of the individual medical plans, Medicare plans do, what they do is they provide you a higher level of coverage than Medicare alone. So you don't have to select this. You could just take plain old Medicare when you turn 65, and that's totally fine. But if you can afford it, or if you have at least, if you have the monthly medical allowance, it's very affordable to be enrolled in this higher level of coverage that this Medicare Advantage plan gives you. Okay, so the premium is $398.05, which is less than, if you go back to the monthly medical chart, it's less than um, the 15-year monthly medical allowance even. So basically, if you have at least 15 years of service credit and you sign up for the Kaiser Permanente Senior Advantage plan for yourself, it's free to get that higher level of coverage. So there's no reason not to sign up. Now, if you have the 10-year monthly medical allowance, 343, I think what was it, 398? I mean, you end up paying what, a little over $50 to have the higher level of coverage, so it's very affordable once you become Medicare eligible. Now, in this chart, what I've done is I'm showing different situations of you enrolling with your spouse or your plus one, and whether you're both Medicare eligible or only one of you is Medicare eligible, or if you're enrolling the family and whether it's like both of you eligible or just one of you and which one it is. And I've also included a line here, just illustrating the 20-year monthly medical allowance and also the bottom line, which would be your out-of-pocket cost for the premiums. And I did this to illustrate a point on this, is that the monthly medical allowance only pays up to the amount of the self premium. You do not get to keep the change for the group plans. Okay, so if you sign up for this and you have the 20-year monthly medical allowance, you're thinking, well, it's what was it, 687 or whatever. Well, no, it only pays up to the amount of the self premium, 398.05. So that would become your monthly medical allowance, and your out-of-pocket cost would be zero. Okay. So you don't get to keep the change, but also you don't have to pay anything. It's basically a free plan for an enhanced level of coverage. So it's pretty great. And then you can see the different out-of-pocket costs for the different combinations. Now, those are all the group plan options for if you're not Medicare eligible or for if you are. What are the other options? What are the individual plan options? So let me start off by saying who can currently enroll in an individual plan through Via Benefits. This is the company that we contract with to provide the individual plans. Who can enroll? Well, if you're not yet Medicare eligible as an Acera retiree, you have to live inside the US. So anywhere in the US, you can find a plan. But we currently require you to live outside of the Acera group plan service areas. So if you live in Oakland, you can't enroll in an individual plan currently. But like I said, we're looking at changing that for the next plan year, but we'll see what happens. So currently, if you live in Oakland, you're not yet Medicare eligible, you're an Acera retiree, you would have to select one of those two group plan options. But you move up to Redding, you move over to Nevada, you move to Florida, you move to Maine, whatever, move to Hawaii. Now you're not in the group plan service area and you can choose an individual plan option through Via Benefits. If you're Medicare eligible, we don't have that requirement, that service area requirement. We don't care about that for the Medicare eligible currently. So you can live anywhere in the US. You could live in Oakland, San Leandro, Pleasanton, wherever. You can choose an individual plan. You don't have to pick the Kaiser Permanente Senior Advantage Group plan. All you need to do is enroll in Medicare, Parts A and B, and maintain enrollment in Medicare, and you can be in a Via Benefits individual Medicare plan, which will also give you a higher level of coverage than Medicare alone. Okay, so a little bit more about Via Benefits. What is it? Like, Via Benefits is a very large company. They're basically a gigantic insurance broker. And then they handle a lot of administrative stuff. So what they call themselves is a private healthcare marketplace. In contrast to the public marketplace, you can get connected with the public marketplace plans through them and use uh, and uh, and I believe use the monthly medical allowance for those. You have to talk to them about that, but you can use the monthly medical allowance for the plans that they connect you with. So they contract with basically every insurance carrier, and all those insurance carriers compete in that one marketplace for your healthcare business. Um, the plans are individual; they're not group plans. You can find a plan anywhere in the nation. Enrollment, you could do it online. You could to look at plans. They have a pretty good interface. You could do it over the telephone, and if you call them, you'll talk to a non-biased advisor who is certified and salaried. So they're not going to push you into a particular plan because they get a kickback. They don't get any of that. And then what they do is they'll have a whole bunch of plans, and you tell them what you need, and you can do this in the online version too. Like there's different filters, but basically you're looking for like how much you want to spend, how much coverage you want to have, whether you want a deductible or not, how much of a deductible you want to have, where you're going to live. You can even get as granular as what prescription drugs you need to take, what doctors you want to make sure are covered in the plan. And so you can talk to the benefit advisor about all that or do that in the online version. And they'll narrow down those thousands of plans to just a few, and then you choose among those. If you enroll in one of the individual plans, the monthly medical allowance not only pays for the premiums, but in this case, you do sort of get to keep the change where you can, if if there is money left over after you're done paying the premium, it can pay for deductibles, co-pays, and other IRS approved medical expenses. And the way the monthly medical allowance works is a little bit different with these individual plans. And this is one of the things that we pay them for. We pay them to administer these health reimbursement accounts. So we don't put your monthly medical allowance dollars into your paycheck from Acera, your benefit check. Instead, we will take your monthly medical allowance dollars that you're eligible for. We send them over to Via Benefits. They put them in a health reimbursement account for you with your name on it. Then they will help you enroll directly with an individual plan with an insurance company, and you will begin paying that insurance company directly, and they'll help you all set it up automatically to happen automatically. So you will be out some money. Then you're going to probably go to visit the doctor since you're in an insurance plan. You'll owe a copay. So you pay them money. Now you're out some more money. So then you submit reimbursement claims back to Via Benefits, and they will pay you your monthly medical allowance from that health reimbursement account that is waiting there for you to reimburse you for your costs. And that's how that works. They have an app. They have recurring reimbursements, automatic reimbursements. They do it. They help you set it all up electronically, so you don't have to think much about it, and you can do all of the individual like copay stuff uh, through their app, and it works pretty well. Okay, one more thing I want to say about the monthly medical allowance. This may change also. This is something the board is reviewing this year. But currently, the way it works is that if you're Medicare eligible and a Sarah retiree, you want to get healthcare through us, so you want to use those monthly medical allowance dollars, and you don't want to use the Kaiser Permanente Senior Advantage plan. You want to choose a Via Benefits individual Medicare plan. What the board has found thus far is that those plans are very inexpensive. And so, in order to maintain the sustainability of the reserve fund, they have offered a lower set of monthly medical allowance amounts for people who are Medicare in those Via Benefits Medicare plans. So this would be the monthly medical allowance amounts you'd be looking at. Um, they do monitor how many people use all of the dollars, and the vast majority of the people do not run out of money. Okay, so let me see here. Let me revisit. There's a question that's been up on the board for a while about the medical, so I want to answer that question before I move on. The question is, I'm over 65 and I'm in the United Healthcare Signature Value HMO healthcare plan. I would like to stay with my doctors when I retire. How do I do that and still take advantage of the monthly medical allowance? Will Via Benefits get me there? I'm aware that I will need to sign up for Medicare before I retire. Okay, yeah, excellent question. So, the good news is that there are United Healthcare plans in Via Benefits, so they can match you with a United Healthcare plan. There may be some other options in there that your doctors also take. So I think that they have a tool, especially if you do the telephone enrollment, that they can find your doctor in the database for those plans, and they can make sure that your doctor has a contract to accept that insurance. And then, so they would help match you with a plan where you can keep your doctors, because you want to keep your very specific doctors. And then you can also use the monthly medical allowance to pay for not only the premiums for that plan, but a deductible if it's a deductible plan, copays, and other IRS approved medical expenses. Um, so yes, Via Benefits will get you there. And yes, you will want to sign up for Medicare. So yeah, if you're already 65, you're not retired. It's good that you haven't signed up for Medicare yet, but I believe you want to sign up for Medicare prior to retirement, like you're saying. And we do have a full page on Medicare. If you go here, retiree, actually, the easiest way to do it, just go to acera.org/Medicare. And we have a full walkthrough here, step-by-step walkthrough, determining if you're Medicare eligible, talking about your coverage options, talking about when to sign up for Medicare Parts A and B, okay, in different situations. Okay, so if you're going to go down to people age 65 and older still working on still working or retired and covered under working spouses insurance. Okay, still working, so this would apply to you. And then you just read that info as part of step 4. So again, it's acera.org/Medicare. Okay, so I hope that answers your question. Let me know if you have additional ones. Okay, we're closing in on the end. We just have a few more things to talk about. I'm going to talk about dental, vision, Medicare subsidy, supplemental cost of living adjustment, and then a few life events. Okay, so let me tell you about the dental coverage that we offer. We have two plans. We have one carrier, Delta Dental. We have two plans that they offer, Delta Dental PPO, Delta Care USA. Now, the way this works is if you have retired from Acera with at least 10 years of Acera service credit or a service-connected disability retirement, you have to choose one of these plans, but it doesn't cost you anything to enroll yourself. The self premium and the subsidy are the same. So, for example, if you retired with at least 10 years of Acera service credit and you enrolled in the Delta Dental PPO, you would see 5435 come out of your retirement check and you'd see 5435 go back into your retirement check in the same check. So it costs you zero out of pocket to be enrolled in the Delta Dental PPO. I think there's a $1,900 amount that you have to spend each year on that. You'd have to look at the enrollment guide for that, acera.org/guide. But there are, a lot of different benefits that you get from that. Delta Care USA is a different option. Delta Care USA is California only. It's kind of an HMO dental plan. Delta Dental PPO is nationwide. You can enroll Self Plus One. You can enroll Family. If you enroll Self Plus One, for example, you end up paying the difference. So you'd see 105.54 come out of your check. You'd see 54.35 go back into your check, and you pay the difference. Now, if you retired from Acera with less than 10 years of Acera service credit, you can still enroll in these plans. There's just no subsidy. You're not eligible for one, and there's a different set of premiums that you would have to pay to enroll in the plan. So that's how dental works. Vision, very similar. There's one carrier, VSP. There's two plans, standard and premium. So they're basically two levels of the plan. There's mandatory enrollment with 10 or more years of Acera service credit or service-connected disability for at least the VSP standard plan, but it doesn't cost you anything to enroll yourself in the standard plan. The premium and the subsidy are the same amount, $4.63. Now you can buy up into the premium plan, pay a higher premium. The subsidy stays the same, $4.63. So you would pay the difference. But the one big difference I know between the two, and you can again look in the enrollment guide for all the little differences, the detailed differences, but the big difference is the premium plan pays for frames every 12 months. The standard plan pays for frames every 24 months. And again, you can voluntarily enroll if you have less than 10 years of service credit. Next non-guaranteed benefit, Medicare Part B reimbursement plan. Okay, so when you retire from Acera and you turn 65, so if you're an Acera retiree and you're Medicare eligible, um, and you are not under the care of a spouse's plans, you should go ahead and enroll in Medicare, Medicare Parts A and B. Medicare Part A is hospitalization coverage. Medicare Part B is doctor's visits coverage, coverage for visiting the doctor. Medicare Part D, as in Delta, is a prescription drug coverage. So you can get a separate prescription drug plan if your Medicare plan doesn't have one. And so when you enroll in Medicare Part A and you have paid into the Medicare system for at least 10 years, Medicare Part A is free for you. If you didn't, Medicare Part A will come with a cost, but you can still enroll in Medicare. Everyone age 65 and older can enroll in Medicare. Now, Medicare Part B, everyone has to pay for. So you will get charged from the federal government. If you're already collecting Social Security, it'll come out of that check. If not, you'll be billed. But there is a cost. And it looks like I haven't updated it for 2026 because we just learned what the amount would be. But I can tell you what it is. It is $202.90 for 2026. Okay. So you'll start getting charged $202.90 for 20 each month from the federal government. That's your cost for being enrolled in Medicare Part B at the base level. And the levels are based on your income. So if you have a higher income, you might have to pay more. The vast majority of people pay the bottom, the lowest amount, $202.90. And what the board has done is because you are having to pay to be enrolled in Medicare Part B, and the plans that we offer you once you're Medicare eligible are only Medicare plans, we will subsidize the cost of being enrolled in Medicare Part B at the base level. So for 2026, again, it's 202.90. All you need to do is have at least 10 years of a service credit when you retire or a service-connected disability retirement. You have to enroll in Medicare Part B and maintain your enrollment, and you have to submit a Medicare Part B reimbursement plan form one time to Acera. So we'll send you a reminder about that whenever you're approaching 65. We will also remind you about that in our enrollment guide every year. But it is definitely a good thing to remember because we don't pay it retroactively. So don't leave that money on the table. If you enroll in Medicare, get the Medicare Part B reimbursement plan, and you'll start seeing the $202.90 show up in your retirement check. And again, if you are Medicare eligible, you're approaching Medicare eligibility, go ahead and read through our Medicare section of our website at sarah.org/Medicare. The last non-guaranteed benefit I want to talk about is the supplemental cost of living adjustment. This keeps you at least 85% of your original buying power in retirement. So if the buying power that you had at the time of your retirement ever erodes so much due to increasing inflation that it gets below 85% of what it originally was at the time of retirement, this benefit kicks in and keeps you exactly at 85% of your original buying power, and you can never get paid less than that. It's a very powerful benefit. And whenever we survey our members on and ask them to rank the benefits and their importance to them, this is always comes in second after the medical subsidy because this keeps you from having that erosion. And I've learned recently that we pay a higher level of this than other counties. Other counties have an 80% or even 75%. You don't have to think about this. It happens automatically and it kicks in if you ever lose 85% of your original buying power. Okay, so last topic. I just want to point out a few life events to you. The first one is if you want to work after retirement, you have various options. And one of these options is brand new. Okay. So your first option, if you want to work after retirement, is you can work anywhere else that is not one of our six participating employers. And we don't care what you do. So we're going to consider you an Acera retiree. We're going to pay you your lifetime retirement allowance every month for the rest of your life. And you can go work wherever else you want. Option number two is that you could come back to work for your employer or one of Acera's six employers. Now, if you do that, there's kind of two sub options. Sub option A is to continue your retirement payments, which means that you continue to be an Acera retiree, you continue to receive your retirement payments from Acera. You don't earn any additional credit toward retirement, even though you're working for one of our employers. And there are restrictions on that. Basically, you can only work half time, and there's a waiting period and some other restrictions. So you're going to want to check those out on the web. Option B, this is the one that's brand new. It's only been around for like a year or so, is that you can come back to work for one of our participating employers and you can pause your retirement payments. So you stop collecting your retirement payment from Acera, it goes on pause, and you earn basically a second retirement. You earn additional credit toward retirement. At the second retirement, once you retire from the second amount of work that you've done, we will restart your first retirement payments, and also you're going to get the cost of living adjustments that you would have gotten had you stayed retired. And we will also then kick in the second additional part of your retirement that you now have earned and combine it all into one check, so you'll be earning a higher retirement allowance. Um, and so you make that choice whenever you come back to work for the Acera employer. There is more info at acera.org/working about that. So you're going to want to read that info as well about doing that. And one more thing that I want to say is that the second time around, you don't have to meet the retirement eligibility requirements because you're already eligible. So you could work any amount of time. You could just work for 6 months, pause the retirement payments, and then decide to retire again and collect a second retirement on that 6 months. Okay, so this is our last slide, I believe. Some more life events that I want to point out. If you decide that you want to stop working and defer your retirement to a later date, you're going to want to read the info on a deferred retirement page because you will become a deferred member and there's some things you want to know about that. Um, should you die before retirement? Hopefully that does not happen. It very rarely happens with our Acera members, but there are death benefits available to your beneficiary should you die before retirement. You should learn about the advanced death benefit election. And if you haven't made that election yet, that's a new thing within the last couple of years. We've revised our beneficiary designation form to where you just have to make a checkbox. What it does is it ensures your beneficiaries receive the maximum benefit, and every active member should do this. Like, even if you don't have that much time left between now and your retirement, you should go ahead and make sure that you have made this designation. There's nothing in your account on our website that tells you whether you've made it. If you don't remember whether you've done it, you can just refill out the form, check the box in section 4, submit it to us, and you will have made the advanced death benefit election. And then the shortcut to the beneficiary designation form is here, acera.org/BEN. Divorce or domestic partnership dissolution. I mentioned this before when talking about service credit, but your Acera retirement that you've earned while married or in a Acera registered domestic partnership is community property that is, that could be divided depending on how you settle the community property in the divorce or domestic partnership dissolution. Um, and there's some things you're probably going to want to know about that. And so I recommend checking out acera.org/divorce for more info on that. Disability retirement. This is where you become permanently disabled and you can no longer perform your job duties with at your job. You can apply for disability retirement, and it's kind of a whole separate process. We have a huge disability retirement page that you can walk through at acera.org/disability. Um, and there's a questionnaire to fill out, but that is an option. If you can no longer perform your job duties, you can go ahead and apply for disability retirement. And then relocation after retirement. Please, whenever you move, fill out our address change form at acera.org/address. Call us anytime. You can contact us at acera.org/contact. Um, Newly, this is brand new as of a few months ago. If you want to email us, you have to create a member direct account and email us through that secure portal because it's way more secure. When you're throwing around financial information, social security numbers, whatever, it's just we want you to do it in the portal. So there's info about that if you go to acera.org/contact. Or you can call us 510-628-3000. Business hours, we have a call center there. They're there. Their entire job is to answer your questions about your retirement. So they're there for you. We're here for you. And on behalf of Acera's Board of Retirement and Acera staff, we wish you a beautiful retirement. You earned it. You spent many years working for the residents of Alameda County, and we want you to have a beautiful retirement. So, um, congratulations.
Perfect.
Take it away.
Good afternoon, my Alameda County family. Again, like Mike said, my name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. I help my clients with creating wealth, passing on that wealth to their family, grandchildren, children, etc. And I'm a retirement counselor. Been doing this for 20 plus years. I've been working specifically with Alameda County employees through my relationship with the county and Empower for the past 16 years. Uh, and really what I've focused on is retirement planning. You know, exactly what is retirement planning? It's helping each and every one of you maintain your current lifestyle in retirement, right? You're halfway there for many of you because you work for Alameda County, you have a Sarah. At a minimum, you're looking at 50% of your salary. Now it's my job, your job to help you cover that next 50% or 30% because most financial planners say you only need 80, but it's up to you. I'm not going to spend a whole lot of time on deferred comp per se. I want to talk a little bit more about what you should expect in retirement. So we want to gear up for a greater future. So let's go ahead and get started here. These are pretty much the touch points throughout this presentation, the quote unquote retirement mile markers. You know, it starts with conducting a situation analysis, determining your retirement income, where it's coming from, Social Security. We'll spend a little time on health insurance, estate planning, your drawdown strategy, meaning how much should you withdraw from your deferred comp to avoid running out of money, being responsible with it. And we'll talk about required minimum distributions briefly. Okay, so let's start with a situation analysis. You know, we want to find out if there is a problem sooner rather than later as it relates to retirement. Now, in my experience, many people wait until like 55, really almost 60, before they're determining whether or not they're in a good space for retirement. And I think you should be doing that sooner than that, in your 50s, you know, or late 40s. You want to conduct a situation analysis. So, what sort of information do you need for that? Well, you want to have an idea of what your retirement savings is to date. How much do you have in your 403B, your 401k, your 457, other retirement plans? You want to have a bit of an idea of how much you should expect to get from Social Security. Go to ssa.gov to figure that out and write down the number for how much you will receive at 62, how much you will receive at 66 or 67, and also at 70. Available assets. How much of your assets that maybe are at the bank are earmarked for retirement? Your current expenses, right? What are your bills today? What are your projected expenses in the future? Okay, so those are some of the things that you want to have gathered in order to conduct a situation analysis. If you need some assistance with this, just have that information handy, schedule an appointment, and we'll help you crunch the numbers. Here are the suggested milestones. Some of the things you want at what age you should start thinking about certain things. So, age 50, you want to conduct a contribution checkup. How much are you contributing to deferred comp or retirement? 59 is an age you want to stop and ask yourself, all right, what are the pros and cons of early withdrawals? Now, the good news, if you invest in deferred comp, there is no such thing as an early withdrawal penalty, so that doesn't apply. But if you have a 401k from your previous employer, 403b, and you're 59 and a half, you actually technically can gain access to your money without a penalty. But don't just withdraw just because you can, you know, but you kind of want to know the pros and cons in relationships to withdrawing at 59 and a half. 62 is an age you want to stop and think, all right, is it appropriate for me to start collecting Social Security? Yes or no? 65 is an age where you want to consider signing up for Medicare. So you want to stop, call a Sarah, have a conversation about Medicare. If you were born before 1960, technically you can start collecting Social Security with full benefits. If you were born after 1960, the full Social Security number benefits is 67. So when you're 66, 67, you want to think about whether or not it's appropriate to start collecting now or possibly wait until you're 70, which brings me to that next bullet point. Okay. And then lastly, 73 is the required minimum distribution age. Uh, that has changed. I'm sure many of you are thinking, well, I thought it was 70 and a half. Well, now it is 73. But keep in mind, real briefly, if you are 73 and you are still working for the county, you're not required to take out this minimum required distribution. So if you have any questions in relationship to that, if you're 73 and you're planning on continuing to work for a little while, I can help you there. Okay. All right. So let's talk about what, let's focus in on if you are under 50 years of age. Keep making your contributions, right? Max is 23.5. I'm going to get to that. But you want to continue to increase how much you're contributing to deferred comp, preferably 1% a year, or if you can do more than that, that's great. When you're under 50, I think you should try to focus on getting raises, getting promoted, increasing your income. That will help you twofold. Number one, if you're making more money with the county, that means you can put more money into deferred comp. So that's going to help you. And then number two, that's going to increase your average salary. Remember with ACERA, and Mike, if you're still listening, correct me if I'm wrong, but uh, ACERA looks at your highest 3 years of salary to determine how much you're going to get from your pension. So
In
as
most
you,
cases.
what's that?
In most cases, if you're tier 2 and 4.
Okay, in most
Yeah.
cases, thank you, got it. So it can help you by focusing on continuing to try to, advance your career, make more money. Okay, review your asset allocation. Do you have too much in something safe? Or too little in stocks, et cetera. So review your asset allocation. Make sure your money's in the right place. Review your retirement strategy. Okay. Do you anticipate retiring at 62 or is it 65? Okay, kind of review that information and then start thinking about estate planning, especially once you've decided to start a family. Okay. Just briefly think about, okay, if I'm no longer with us, my family, will they be taken care of? Will my spouse, will my kids be provided for? So those are some things you want to be thinking about when you're under 50. Okay. Now let's talk about if you're 50 plus. I'm going to briefly go through maxing out and catching up is what you should be thinking about age 50, fine tuning your estate planning and making sure your beneficiaries are in place. Okay. So the IRS limit right now in 2025 is 23,500 if you're under 50 years of age, an extra 7,500 if you're 50 and over. Um, Limits in 2025 for IRAs are the same, 7,000 and 1,000. Um, Unfortunately, we haven't been officially notified of what the new maximums are for 2026. So I'm not going to speculate there, but I will say that typically, these numbers go up by like $500, $1,000 max. But stay tuned. We'll reach out to each and every one of you to let you know exactly what the maximums are for 2026. Okay. If you are 54 and a half at the earliest, you feel like you haven't taken full advantage of deferred comp and you want to kind of make up for lost time, there's something that's called the 3-year catch up. This is a program where you can invest $47,000 a year for the next 3 years prior to retirement. And you don't have to retire after the 3 years, but you just have that 3-year window and it's a consecutive window. You can't start and stop. You have to, if you decide you want to take advantage of this, you have to see it all the way through and money comes from your paycheck. So some of you may have to invest half your paycheck to take advantage of that. I don't know. But if you're interested in learning more about the 3-year catch up or the last 3 years special catch up, let me know. Okay, let's talk about estate planning a little bit. Many people think that estate planning is only for people who are rich. Well, I say if you own a home in the San Francisco Bay Area and you've held it, you've had it for 20 plus years, you're considered rich, right? And so you want to start thinking about estate planning. What's part of estate planning? Well, you have your taxes, you have wills. Does a trust make sense? You want to iron out who's going to get this special family heirloom, because this is something I'm telling you, your kids, your family members may fight over. So you want to have that included into your estate plan. You know, you want to make life easier for your family because it's going to be hard enough dealing with your loss, but you want to make the money situation as seamless as possible. So try to think long and hard about creating an estate plan. Okay. What is a living trust? A living trust typically is used to help skip probate. What is probate? Probate is the process where your family members have to solicit the court system in order to determine how your assets should be split. A will is not enough. A will still has to go through probate. Okay, so it's extremely problematic. It takes a year before truly all of your beneficiaries get their money versus if you have your money inside of a trust, you know, everything could be split pretty quickly. Creating trust aren't really that expensive any longer. If you have signed up for, I believe it's called MetLife Legal through the county, you can hire an estate planning attorney that can help with that. Number two, I believe EAP can help with finding an attorney for you. If you need some assistance from me, Gene, you know, do you know an estate planning attorney that is appropriate for me in my situation? I can um, help you out with that. So just reach out to me. So, living trust, naming a beneficiary on your retirement accounts, keep in mind that does not go through probate. So you don't have to worry about that. But you want to make sure that your beneficiaries are accurate on all of your accounts. Okay, so I would encourage if you have deferred comp account and you're unsure who your beneficiaries are, create a user ID and password for the Empower account and then just add your beneficiaries right there on the site. That's going to be your new beneficiaries. Okay. And this is, if you log on to AlamedaCountyDCP.com, if you have a user ID and password, not put that in there. If you need to register, do what you have to do and then add your beneficiaries. Okay. Let's talk about a little bit about tax diversification. All right. Here's an example of a person who's retired. They've decided to take $50,000 out of their deferred comp account. They've invested the money pre-tax. Okay. So you're looking at roughly 20% tax bracket. You're looking at netting $44,000. Okay. So that's a pretty significant tax hit. But let's say hypothetically, you decided that you wanted to put a portion of your money in the pre-tax version of deferred comp, and you wanted to put a portion in the Roth version of deferred comp. You're retired. That's basically going to cut your taxes in half when you start to withdraw money. So you're only going to be taxed on the 25,000. That's the taxable income. The Roth side, there's no taxes at all. You already paid the taxes going in. So this is something that I'd like everyone to consider is to, you know, kind of have a little bit of your money invested in the Roth after tax and pre-tax. Okay. If you have more questions regarding that in your situation, just reach out to me and let me know. All right. So let's talk about the milestones for if you're 60 plus. You want to kind of come up with a strategy in terms of when you should anticipate collecting Social Security. Determine what your full retirement age is. It's either going to be 66 or it's going to be, 67. Okay. Calculating your benefits. So let's dive in taxes. Let's dive into what is full retirement. All right. So here's a little chart that I like to show. And like I mentioned before, if you're born before 1960, full retirement is 66. But depending on exactly what year you were born, it could be 66 and 6 months, or for example, if you were born in 57, full retirement is 66 and 6 months, et cetera. You get the idea. But if you're born after 1960, full retirement is 67. How do you determine if you're eligible? I mean, if you've worked at least 40 quarters, 10 years, and you've paid into Social Security, it's yours. Okay. And I believe as of late, or recently, there was a new law that was passed. I think it's called the Social Security Fairness Act or something like that, whereby If you were a government employee and you didn't pay into Social Security, you're still entitled to Social Security. So that's a win for folks who, like a sheriff deputy that doesn't pay into Social Security. Looks like you're going to be eligible to also not only collect your ACERA benefits, but also collect Social Security. So I don't know the intimate details of that, but I do recall that at passing. So that's good news for many of you. Okay. How do you calculate benefits? How does that work? Well, they take a 35-year work history, and they take the average of what your salaries were to determine um, how much you're going to get in Social Security. Now, obviously, here, if you didn't work the full 35, say you work 30 years, well, they're going to say 5 of those years you had no income, so it's zero. So because it's zero, that's going to push down your benefits in terms of Social Security. So just keep that in mind. I also have found that the Social Security Administration um, doesn't always have accurate records in terms of your annual income. So that's another reason why you want to log on to SSA.gov to at least determine how much you're going to get from Social Security, but then also make sure that the income information that's in Social Security is accurate. Okay. Here's when you're calculating benefits. Um, let's go back. Let's back up here. All right. So if, for example, you were to collect Social Security early at age 62, that's your prerogative, but you're going to get roughly 25% less than what you could have gotten. And it consistently will get worse, but it gets better as you move closer to full retirement. So if you're 62, you're taking a big haircut. But if you can wait to 63 or 64, it's not full retirement, but it's still a little bit more. And it continues to move up until your full retirement and you'll get the max benefits. And you can also wait until you're 70 to collect Social Security. Now, some of you may be thinking, all right, when is a good time to collect Social Security? Should I collect it at 62? Is that the best place? 67 or 70? And typically that involves your expected life expectancy. Let's be honest here. If, for example, you anticipate living until you're in your 90s, when you do the math, collecting it at age 70 makes the most sense. If you have, God forbid, you have some health issues, you have to retire early, you don't think you're going to be with us all that long, then collecting it early at 62 is best. But as you know, many of us fall right smack dab in the middle, and collecting at full retirement makes the most sense. Okay. Now I will say this. This is my own personal opinion. I've kind of changed my tune when it comes to Social Security. There was a time where I said, you got to wait until full retirement to get your maximum benefit. You're leaving money on the table when you collect it early. And we went through COVID. And unfortunately, a lot of our fellow Americans didn't make it through that process. My family members passed away prematurely because of COVID. So I've determined that life's too short. Tomorrow's not always promised. If you're in a situation, hypothetically, you're 62, you feel like you want to retire, and just ride off into the sunset. You're 62, you do the math on a Sarah, it's really not enough to sustain your lifestyle, just a Sarah. But if you were to collect Social Security, you could retire comfortably and be fine. In that scenario, I say take Social Security at 62, take your Sarah, and enjoy your retirement. Tomorrow's not promised. Yes, are you leaving some money on the table? Absolutely, right? But wouldn't it be unfortunate and sad if you're waiting until 66, 67, and you don't make it? You never got a chance to enjoy your money. So that's my take. But you can listen to my opinion. You can talk to your family members. You can talk to, your local attorney, the attorney you work with, your CPA. They can give you some tidbits in terms of when to collect Social Security. But I just wanted to make sure I expressed, my thoughts surrounding Social Security. Is Social Security taxable? For many of you, it will be taxable. It's pretty much based upon your income for that year. Yes, when you retire, maybe you're not working, but you're still collecting a SARA as your income. So if you're single, you make more than $25,000, a portion of it's going to be taxable. If you're married, you make more than $32,000, some of it's going to be taxable. Okay, so those are some things you want to keep in mind, but check with your CPA, check with your tax accountant for your own personal situation to know for certain whether or not in your situation Social Security is going to be taxable. 65 is, I'm not going to spend a whole lot of time here, but as many of you are aware, that's when you need to sign up for Medicare. But I would also tell you if you're still working or if you're about to retire, come up with a withdrawal strategy um, in terms of should I take out 4% of my account? Should I take out 3%, 6% of my account every year? When should you take it? And here's where I'm talking about health insurance. Sarah, the last I heard, had a great seminar as it relates to Medicare. So I would encourage you to participate in that. And I would participate in even before you retire, just so you understand the pros and cons of Medicare and the different parts that are associated with Medicare. Okay, let's talk about income. What accounts should you tap first? In my view, when you have all of these different buckets of money, my opinion, you start tapping your money that has already been taxed. So any money that's maybe in a CD or in a brokerage account, trust account under your name that's already been taxed, start there. Then move on to your pre-tax money, your before tax money. And then lastly, tap your tax-free money. That's your Roth money. Okay. Those are the different buckets I would go through as you're creating income for yourself in retirement. If you want some more details or you need some answers with respect to your personal situation, just reach out to me. Even when you retire, there's still risks to your income. There's market volatility. Who knows what the market is going to do when you're retired? So you're going to have to deal with that. Tax strategies. Are you going to be in a higher, lower tax bracket in retirement? You got to, make sure you're making the right decisions there. Low interest rates. If you tend to use CDs as your investment strategy or investment accounts, as you know, as interest rates start to drop, that means your money's not going to earn a whole lot in a CD. So you want to deal with that. Inflation, the cost of goods and services going up over time. If inflation on average runs at 3%, but you're only earning 2% on your money, that means technically you're losing money, losing about 1%. Higher taxes, cost of living ties into inflation, and then you have longevity, right? You just can't assume, all right, I'm going to live until I'm 80 or I'm going to live until, I'm 85. You may make it to 100, right? And so if you're not thoughtful about how you're spending your money, you could potentially run out of money pretty quickly. Okay. Here's a little information on Medicare. It begins at 65. You need to sign up. Part A, Part B. Check with a Sarah, sit through those seminars to get more information about Medicare. Okay. Let's talk about 70. The new age in terms of required minimum distribution is 73. So at 73, you're required by law to take out your minimum required distribution, which is based upon your life expectancy tables or on the tables. How much is it? It's roughly 4 to 6% of your account balance needs to be taken out. If you don't do that on a timely manner, in a timely fashion, the IRS could hit you with a 50% penalty. So hypothetically, let's say your RMD is supposed to be 20 grand and you neglected to take it out. You could get hit with a penalty of $10,000. So it's you want to make sure you're on top of this. Now, I probably mentioned it earlier, but if you are 73 and you are still working, you have your deferred comp, you don't have to take out your RMD because you're still working. Okay. Now let me repeat that. If you're with the county, you're working at 73, you have deferred comp, you don't have to take money out. So you're good to go. However, if you have a 403B, 401k, you have an IRA outside of the county, then you are subject to the RMD with those accounts. Okay. So I just want to make sure everyone is aware of that. Okay. Now, when the time comes, you're going to get a letter from Empower. You're turning 73. Here's some forms. If you need some help completing the distribution forms, let me know. The other thing I would encourage each and every one of you to do is to make Empower calculate your RMD and send it to you automatically without you having to complete paperwork. Why? Because I have found as you age, if you don't need the money, you may forget. And we all know what will happen if you forget to take out your RMD. So have Empower calculate it on your behalf and make sure they send it to you. Okay, that's my preferred method. Some people also are probably thinking, well, how much? I know I got to pay taxes. How much will I have to pay in taxes? Are my taxes on this distribution based upon my age? And the answer is age has nothing to do with taxes. It's all about income. How much income did you generate in this year, plus what you're getting in your RMD added together? That's your tax bracket. So it's entirely possible your taxes could go up depending on your income, because I believe with your ACERA, you get that cost of living adjustment that gives you a bump 3-4% or even more every year. So that means you're making more, and so you're potentially going to be you're going to have to pay a little bit more in taxes. Okay, so I just want to make sure everyone was aware of that, and I talked about the penalty on that. Once you leave county service, what are your distribution options? You can leave the money in the plan, right? My dad used to always say, if it ain't broke, why try to fix it? If deferred comp's been working for you throughout your career, you have the option of leaving your money in the plan. However, if you have a trusted advisor, investment person who appreciates investing in stocks, individual stocks, not mutual funds, then that may make sense to roll your money out. Or if you prefer to invest in real estate, you want to move money into a self-directed account and buy real estate, knock yourself out. That is an option. But if you're the type of person that's probably just going to invest in mutual funds, then it may make sense to stay in the plan. Because right now the county's plan is about $1.5 billion. So because of the size of the plan, you're a $1 billion client of Empower. So the fee structure, investments, et cetera, are tied to that. Versus if you move money out, say even if you move $1 million, well, you're still may not get the same types of benefits as you get from deferred comp. So that's just something to keep in mind. So you can create your own portfolio. You can use GoalMaker if you're using it now. GoalMaker is that award-winning program where you tell us what your investor profile is. I'm conservative, moderate, aggressive, the year you're going to retire, and then boom, you're off and running. There is a new managed account program through Fisher Investments that you still have access to even as a retiree. So be thoughtful about those decisions, because if you roll your money out, you can't roll it back in, unfortunately. Now, I believe the manager of deferred comp is trying to change the rule on that, because a lot of participants are trying to come back. But for now, if you roll your money out, you can't roll it back in. Okay. So the end is just the beginning. I mean, you've spent your entire career being responsible, making sure you're putting money away towards your retirement, and that's great. But it's the beginning. It's the end, but it's still the beginning, because you have to be responsible about making sure you don't run out of money, right? And I'm sure many of you aren't going to run out of money. Sometimes I get frustrated with some retirees; they don't spend enough. I mean, in my view, you can responsibly spend 5% of your deferred comp a year. That's okay. 5% will work, but I want you to start spending your money. You've worked too hard. You've sacrificed too much for your family, etc. You should be able to enjoy the fruits of your labor in retirement. So if you want to take that trip to wherever, do it. If you want to buy that car, that brand new car, I know there's quite a few participants I've kind of talked into buying a new car for themselves. Okay. Treat yourself, but be responsible with your money. 5% is a really good number that you can work on. Okay. Excuse me. I got someone calling me. Okay. So with that, I'd love to entertain some questions. Well, real quick, let's see. Sarah, you guys know about that. Oh, let me talk about this, Mike. I completely forgot.
Sure.
If you if you have time left on the books in terms of vacation, if you don't need the money, I would encourage you put that money into deferred comp. And Mike, did you talk about purchasing a Sarah service credit in your presentation?
Briefly, yeah.
Briefly. Okay, so you briefly touched on that. You can use your deferred comp money to purchase service credits. So I just wanted to make sure I brought that up. And I mentioned AlamedaCountyDCP.com to create a user ID and password. Here are the different financial advisors. Here's the website you can go to schedule an appointment. Here's the telephone number, 855-969-4572. If you want to get a hold of me directly, you can call my office at 510-562-6355, or you can email me at g underscore Hilliard, HILLIARD, at emergefinancial.com. Okay. So with that, now I would love to entertain some questions. So go for it.
Amazing. Thanks so much, Gene.
It's my pleasure.